Data check. Of course, we look on our Fed Day, as we do across all of our various shows, at equities, bonds, currencies, commodities. We were green. We're not now. Red, a little bit of nervous on the tape. Yields come in 3 basis points. Yeah, but, you know, Scarlett, those of us that get up early, like I'm here at the crack of 7 a.m., you're looking at 157, 153, and oil again under $42 a barrel. I would look at the 2-10 spread, a little bit of flattening here. Again, that nervousness in the market. And Scarlett, to your point on yen, weak yen earlier this morning was the major story as well. A good set of guests today. Jeffrey Rosenberg with us quickly here before the meeting with BlackRock. Jeff, you and I talked this morning. I guess the simple idea here is, will there be language in the statement that drives the discussion forward?
Yeah, I think that's the key point. You know, the economy, the economic data has been better, so we look for the Fed to acknowledge that. And the Fed just acknowledging that the data is getting a little bit better will keep that narrative in the market's eyes. And what you talked about, Scarlett, earlier about the BOJ going in the opposite direction, this might come out at the end of the day as a bit of more divergence, and that is impactful to the dollar and the currencies. So I'm sure we're going to talk about that.
Well, does Abe's stimulus mean lower yields in the U.S., thereby making the Fed's job a little more difficult, a little harder?
Well, certainly the big expectation around the BOJ is what do they do, and we've certainly had support in terms of the flow of assets from Japan into the U.S. It makes the job a little bit easier, yes, in some sense, but it makes financial markets a little bit more uncertain because we're not exactly certain where along the yield curve that impact is going to fall.
Real quickly, we've seen strengthening in the dollar lately. I have a chart here in the Bloomberg showing the Bloomberg Dollar Index really rising a lot. You know, since it bottomed, since a recent bottom in early May. How much does that affect how the Fed sees things going forward?
Well, it's a big part of the story. I think a lot of what the dollar is responding to is the shift in the Fed's rhetoric, the strengthening in the U.S. data, the easing of concerns around Brexit, which has brought the Fed back into play, and again has brought a little bit of divergence back in the story. There's a limit to how far that can go because you're seeing some of that dollar commodity price risk show up again. The dollar appears to be leading commodity prices. Certainly today is a supply story, but we got to watch that.
Okay, and limit is a good word. It's a good key word here as we approach the FOMC decision. Ahead of that, we're looking at stocks. Little change. The Dow off by no, it's unchanged right now. Let's go to Mike McKee at the FOMC.
No change in policy. No change in rates. Only a few changes in the economic assessment. There's no mention of economic activity overseas or the dollar, and certainly no time frame for future action. But if you're feeling hawkish, there is this inserted into the second paragraph, a statement noting that near-term risks to the economic outlook have diminished. That suggests that members may feel conditions for a rate rise have grown more favorable, and investors certainly may take that, if they want to, as a sign September could be a live meeting. As far as the assessment, the Fed says specifically that the labor market has strengthened, noting what they call strong job gains in June, and that payrolls and other labor market indicators point to what the statement calls some increase in labor market utilization in recent months. Economic activity has been expanding at a moderate pace, this statement says, although there is concern about the level of business spending, which was a concern they expressed in the June meeting as well. There's no change in their inflation outlook. It's running below the 2% target, partly, quote, reflecting earlier declines in energy prices and imports. That's what they've said before, and they continue to expect it will rise. The statement does note that market-based measures of inflation compensation remain low. Survey-based are little changed. And we are back to dissents. Kansas City's Esther George saying she would have preferred to raise rates by a quarter point this meeting.
Michael McKee, thanks so much. Michael, what else did you see quickly in the statement? I mean, I look at the Esther George dissent. That gets your attention. The 2-year yield moving up, the 10-year yield clearly moving up, and the 2-year just as much. We'll show you that in a minute. Michael McKee, what else did you see?
There's almost nothing different, Tom. The statement in the third, fourth, and fifth paragraphs exactly the same as in previous months. The only real change that is of note is in that second paragraph where, again, they add the sentence that near-term risks to the economic outlook have diminished. That was the concern that came up when we saw that bad jobs report in June, that maybe things were going to deteriorate from here. The Fed seems to be telling us they don't think that is going to happen. The economic assessment, well, anybody could have written that. We know there were stronger job gains. So not a lot of changes in how they see things. They're just not as worried as they were.
All right, we're seeing a reaction. You can see the dollar index jump up there. Also seeing a rise in 2-year yields. We're back here with Jeff Rosenberg. What are you seeing in the market reaction or the statement that stands out to you?
You're seeing a pretty good curve flattening, so that's pricing in a bit of Fed tightening expectations, certainly on the front end of the curve. I think the assessment in terms of that second paragraph is the most important in terms of easing the near-term concerns. A lot of that was Brexit related. A lot of that was labor market related. And certainly that is consistent with what you're seeing in the front end of the curve, pricing in a bit of increased probability of Fed action, whether it's September or December.
You mentioned the curve flattening. It's down to 78 basis points between the 2-10. We'd been lower earlier in the year, but how much of a problem is that for the Fed, the fact that that long end of the curve is so unresponsive?
You know, it is a bit of a problem if the Fed is thinking about it from a very traditional point of view. I don't think the Fed is thinking that way. I don't think the markets are thinking that way. The long end of the curve, you mentioned the 2s, 10s. I'm even looking further out in terms of the flattening that we're seeing in terms of the 30-year part of the curve, is so influenced by what's happening in the rest of the world, the global conditions. And so the traditional measures of looking at the long end of the curve and seeing it as an inflation indicator, we're gonna asterisk those with, well, what's going on in terms of the BOJ, the ECB, seeing a flattening in the euro curve. So I think that's going to ease some of the concerns about what the flattening means from a fundamental economic interpretation point of view.
Tom and I were talking earlier about how this meeting would be important for Janet Yellen, the chair, to create maximum optionality. Did she accomplish that?
With this meeting right here, I think this is a marginal move. It's pretty much as expected in terms of upgrading the economic activity, the language shift towards easing near-term concerns. I think in terms of optionality, the Fed has maintained their optionality. I think most importantly in terms of the optionality, the issue is that the Fed can't have the option to be cutting interest rates, to be normalizing interest rates when the market is not expecting that at all. So when you get those expectations back into the market, as you've seen in some of you've got a nice function on Bloomberg in terms of the implied probabilities. When you get that in place, that gets the Fed's optionality back, and that helps the Fed going into September here. And that's what you're seeing with the front end of the curve.
And part of the options, folks, is forecast. Michael McKee is a little bit better at forecast than I am. Michael, what do you see in forecast, past, present, and like the Christmas Carol into the future?
Well, this is definitely not October of last year where they said specifically they were getting ready to raise rates at the next meeting. They do want the optionality that Jeff was talking about. And where we are now is you go back to their last economic forecasts in June. And what they've done is take off the table concerns that the forecasts are going to be wrong. So if the economy develops as they expect, which is the language they always use, then they could raise rates. We're back in conditions where they could raise rates. We're back to data dependent. So we'll watch the data between now and September. The real concern after Brexit, after the May jobs report, was that the economy would slow down significantly. If it's not doing that, if it's following the path they expect, that was a path they thought would lead them to a couple of rate increases. And so we're back to that being a possibility.
Okay, Jeff Rosenberg, to appear with us today, demanded fireworks. We're going to do that right now with Dots Go. For those of you on radio, this is a beautiful and wonderful thing. We'll send it out to you on Bloomberg Radio Plus. From September of 2013, the market is the red line, and the green line is the median of the geniuses at the Fed. Here we go. They get farther apart. The vigil, Jeff.
That's awesome.
Jeff, I don't know what to do, Jeff.
Like a
here we
time-lapse.
are. And here's the massive gap, Jeff. We'd show it again, but it's, you know.
That was like making a GIF live on TV.
It is, but it's like children are watching, so we can only do this once.
Thank you for the fireworks. Appreciate it. What do? You ignore the dots.
You ignore the dots, but never have we seen the vigilantes so far away from the dots.
Well, you know, the dots have been a really, really bad guide to what's going to happen in the market, and a lot of that has to do with the Fed in terms of adjusting its expectations, its forecasts, overly optimistic every year. So the dots, really, the market has been a much better guide towards where the Fed's going to go rather than the dots.
And that's the key insight.
Absolutely.
Yeah. Joe, what do you have?
I'm looking at a chart that I track on the terminal of various inflation measures because one of these themes that people always say is, the Fed's failing to generate any inflation. But by lots of measures, things are going up in the right direction. Fed wage growth, Atlanta Fed's wage tracker, CPI services ex energy, Cleveland Fed trimmed mean. Most of these have been going in the right direction. When you look at that huge gap that Tom showed between the market and the Fed, could we one day get to a moment where we're clearly hitting those targets and the market's really off sides where the Fed is going to go?
So these charts here and this broader conversation about the disconnect between market measures of inflation, both in terms of nominal interest rates as well as the other way you could look at it is in terms of TIPS, implied inflation, and what we've seen in terms of the core measures of inflation. This is a bigger, longer run concern because there is this disconnect brewing between some signs of increases in inflation and expectations, as we talked about in terms of the dots, for low interest rates for a very long time. And this is because we've had a very persistently disappointing history when it comes to production of inflation. And part of that is a headline story that confuses it because we had this big decline in oil. But what we're starting to see is the core measures of inflation turn and the bond market lagging that. Part of what masks that as well is the yield curve typically should steepen when you have inflationary concerns, yet the yield curve is flattening because of these global concerns. So there's a lot of new factors in today's bond markets. QE, unconventional monetary policy, negative interest rates, the global influence on interest rates that's making a lot of those traditional relationships less reliable. And so we certainly have to watch for that inflation picture in the U.S., but we also have to look at the global inflation picture.
And the other thing, Jeff, is when you look at the dot plot, that's a stale forecast. These were turned in at the beginning of June. You ask Fed officials now, they might have a different, more nuanced view of where they see things going. So you kind of have to throw that out, as you suggested. One of the interesting things to focus on in their statement is the inflation part. They don't change anything about their forecast for inflation, but they do note that they still see market-based inflation measures as remaining low. They're still concerned that people are thinking we're headed towards deflation rather than inflation, and suggests that at this point, the market's telling them that inflation is not something to worry about.
Yeah, and that reference to the market-based inflation indicators is the reference to TIPS levels. TIPS implied inflation levels have been coming off lately. They've been lower than what the core figures have been saying, and it's been a big concern because the concern in terms of inflation dynamics is inflation expectations. And if market-based measures are one of the things that influence inflation expectations, the concern is whether or not this low inflation, this disinflationary, and the deflationary fear gets embedded into expectations. That's one of the big fears.
Yeah, I would go with that, but I love the chart Joe had showing 28 flavors of inflation. I want to zen in, a zen-like Joe Weisenthal chart. We need to get zen. There it is. One of the lines Joe had. Major shout out to one of our guests this morning on surveillance. This is what, 48 hours ago?
Yeah.
Service sector CPI, core service sector CPI is back to trend, 3.2%. And Jeff Rosenberg, very simply, folks, and on radio, the mail we get in our mailbox. Joe gets mail, Scarlett gets mail. I don't get any mail. And what the mail is in their mailbox at home is inflation, and that's it, Jeff Rosenberg.
Yeah, so the chart that we're showing here, this services piece, is a big part of the inflationary story. So we were talking a moment ago about the headline figures. When you open up the hood and look at what's going on underneath that, is you have this big dichotomy between services inflation, which has been rising, and goods inflation, which has been falling. And the goods inflation is holding down the overall inflation figures, while what a lot of people feel in terms of their services side of the economy, as that chart was highlighting, is certainly increasing. So the risk here is that if goods inflation or disinflation stops pulling overall inflation downward, then the services side picture that you're clearly seeing is going upward starts to show up in the core figures. And that's already what we're seeing in some of those core headline figures going up.
Well, it's a great conversation. We're going to drive it forward with Jeffrey Rosenberg of BlackRock. Coming up on Bloomberg Radio and Bloomberg Television, the former president of the Minneapolis Fed, Narayana Kocherlakota, at Rochester now. He has been controversial. Jens Nordvig, we're thrilled to bring you today from Exante Extomura. Jens on the currency markets, and particularly Scarlett's focus on BOJ. And then I speak after the 3 o'clock Wall Street Time hour with Mr. Gross of Janus. Stay with us. welcome all of you worldwide and across the nation. Of course, we've heard from the Federal Reserve pretty much as expected. We're getting good perspective. Scarlett Fu, Joe Weisenthal, myself, with Jeffrey Rosenberg of BlackRock, and Michael McKee in Washington as well. Very quickly here, Jeff, I want to talk about where we are on yields. We've got nominal yields and real yields that compress down. They go down to Paul Krugman's zero bound, where there's not a lot of degrees of freedom for Janet Yellen. Is it even feasible that they could visit negative real rates or negative nominal rates in America?
I think the question you're asking is negative nominal rates. And if you're asking negative real rates, it's a question about what we were talking about earlier in the segment in terms of inflation. Can you get more inflation? That's the goal, right? The goal is to try to get more inflation. You're seeing some rising expectations for a moderate increase in inflation, but only back to around 2%. That'll help push real rates lower. But the other question on nominal rates is the other conversation. Yeah. Negative interest rate policy here in the U.S. Would you ever get that? That's not the conversation, and that's clearly not the conversation we're having today. Today is about upgrading the assessment, the near-term balance of risks. That's really kind of the major takeaway today. That's a little bit more hawkish, a little bit more setting up the market for normalization, maybe even a little bit earlier than had been expected. And so we're pushing the Fed away from the conversation around negative rates. Tomorrow night into Friday morning's story is going to be about negative rates and the BOJ and market expectations that you will get another maybe 10 basis points move into negative rates.
I want to ask you a question that I think is probably particularly relevant at BlackRock from the perspective of investment manager. We're seeing bonds and equities sell off. They've been rallying together for a long time. Now we're seeing days when they sell off. So many people have portfolios that are a mix of the two, premised on the idea that one hedges out the other. How challenging does that make your job when they move the same directions on the same day?
It's a great question, and you know, when thinking about asset classes, you guys will always ask me, you know, what do you think about bonds? You like bonds? You don't like bonds? I often will answer, you know, it's not really about bonds in isolation. It's about bonds in a portfolio, and at low levels of rates, when the Fed is expected to normalize, and what we're talking about today, raising rates, why would you ever hold bonds? It's because of that portfolio characteristic. So when you lose confidence in that portfolio characteristic of bonds being ballast to your equity portfolio going in the opposite direction, it absolutely is one of the most challenging things. Now, what we saw in the case of Brexit, what we've seen in other periods earlier this year in terms of risk off when we had the big China currency commodity concerns, is we saw the traditional role of bonds being reasserted, that bonds were ballast. But we have seen in the recent past the taper tantrum where that can break down, and that can be very challenging to the portfolio. It's one of the main things we focus on in terms of our assessments of what do we think the correlation between risky assets like equities and bonds will be. Most recently, the correlation has been traditional in the sense that bonds have been doing their role as ballast in a portfolio.
How about in recent days when the 2- and 5-year Treasury auctions met not so great demand?
Yeah, so there's obviously the high frequency observations, and you can have data that moves in opposite directions from that. And the question is really, you know, signal versus the noise, and filtering out some of the noise for the signal. I think where yields are today, particularly in the back end of the yield curve, you will still have that traditional relationship. Now be careful, because the traditional relationship cuts both ways. Sure. So if things are getting better and the Fed's normalizing, you know, those rates will go higher, and potentially that's higher in an environment where the economy is doing better and potentially risky assets are doing better.
All right, Jeff Rosenberg, stay with us of BlackRock. Also a reminder that you can follow our top live blog for analysis and market reaction on the Fed's decision on your Bloomberg. That's TLIV Go, and right now we're looking at, for instance, the WIRP function, which indicates that the odds of a rate increase now for September have gone up to 29.8%, and for November it's at 29.8%. In fact, it exceeds 50% once you get to March 15th of 2017. Still ahead on Bloomberg Television and Radio, former Minneapolis Fed President Narayana Kocherlakota joins us about why he's at odds with Janet Yellen. This is Bloomberg.
Hey. Sorry to be late. Did you hear about the NATO plane downed by Russia?
No.
The markets are a mess. Everybody's selling, or at least trying to, if their brokers are up and running.
But it's almost 8. Everything's closed.
That depends who your broker is. I can trade in Chicago, London, Hong Kong, right now. Wow. The market's already down 2%. I'm sorry, I need to do some hedging trades.
You want to trade here, right now?
Yeah, let's just take a minute.
Wow. Who's your broker?
This is a special report. The Fed decides on Bloomberg Television and Radio. I'm Scarlett Fu along with Tom Keene and Joe Weisenthal. We are discussing global central bank policy. And if you were to look at a chart of spreads between 5 and 30-year yields, they are flattening in Germany. They're flattening in Japan. The U.S. is following along as well. We're joined once again by Jeff Rosenberg of BlackRock and Narayana Kocherlakota, the former Minneapolis Fed president, currently at the University of Rochester. Jeff, I'll start with you. It is your chart, and you talk about how U.S. Treasuries keep getting bid up because they're attractive relative to the zero and negative rates that we see in Europe and Japan. But it's a lot more complicated than that, isn't it? It's not just a relative attraction argument.
That's right. And that chart we took from our July piece where we talked about foreign influences on U.S. Treasuries and understanding what are the factors that determine that. Now, the simple way of thinking about it is just U.S. yields are low and U.S. yields are high relative to foreign yields, which are much lower. But when you make that international comparison, you have to consider what are the FX or the hedging costs. And when we consider the FX component to the outlook, then what we see is that more than just the absolute level of yield differences that matters, it's the yield curves, because the yield curves capture the relative hedging, a portion of the relative hedging costs. And so when you think about the relative hedging costs, what we see is that it's the yield curve flattening in the foreign bond curves that has helped to influence a flattening in the U.S. curve.
How much do you see that factoring into what the Fed looks at and how it decides on communicating monetary policy, Professor Kocherlakota?
Yeah, I think it's one of many factors that go into the communication game for the Fed. I think that, I think that that's one piece of the puzzle, but the broader picture for them is really, I think, thinking about how to do a better job of communicating the various factors that are going into their decision making and making sure that markets know those factors, as opposed to simply our debating back and forth about are they going to go in September or are they going to go in December. I think really the Fed should be doing a better job of communicating what are the factors that are going into their decisions, and then having the markets forecast how those factors will evolve.
Professor, what is their mandate right now? It seems to be a mystery to me. In 25 words or less, undergraduate Econ 101 at Rochester, what's the Fed's mandate?
The Fed's mandate is to promote price stability and promote maximum employment. That means to keep inflation close to 2%, and that means to keep unemployment low. Now I'll add beyond my 25 words for the undergraduates for you, Tom. I think the big challenge for the Fed is that it's not just about what the central bankers like to call your modal outlook, or where you expect the economy to go. It's about the risks, that outlook. Mm-hmm. And in particular, you're really worried about the downside risks, that outlook, because you don't have as many tools in your kit to offset those downside risks. So you're probably keeping rates lower than you would just based on your modal outlook because of your concern about those risks.
We're going to sic someone from Carnegie Mellon on you. Jeffrey Rosenberg, a question for Dr. Kocherlakota.
Yes, I wanted to get your thoughts on the data dependency of the Fed, and whether it's data dependency or data point dependency. We've seen a lot of short-term data. Obviously, the labor market, we had a lot of text dedicated to that in the minutes. What are your views on how sensitive is this Fed to short-term data?
Yeah, it's unfortunate. I think that at times the Fed is conveying the message that they're relatively sensitive to short-term data. I think that it's really more monetary policy is much more driven by the 18 to 24-month outlook for what's happening with the economy, and including the risks that I mentioned earlier. But certainly, the data dependence mantra has, I think, actually confused things a little bit in terms of conveying that really what the Fed is looking at is, do payrolls come in at 200 or do they come in at 50? And no, I know my colleagues are looking at a broader picture than that. And I think, again, they need to do a better collective job of communicating that.
Professor Kocherlakota, what would have to happen for Janet Yellen to signal in Jackson Hole next month that a September rate hike is on the table, that there is that optionality?
Yeah, I think we're getting a lot of news next week, and I'm sure that news will be a part of what shapes her Jackson Hole speech. What I'm hoping for Chair Yellen, to hear from Chair Yellen, is actually not so much about what's going to happen specifically in September, but really maybe a broader framework that allow Fed watchers and the public and markets to know how the Fed is going to be thinking over the remainder of 2016 and really into the first half of 2017 about interest rate decisions. Chairman Bernanke did use Jackson Hole in that way. It's a little more expansive framework and venue than she's usually afforded. And so I'm hoping that she'll use it that way as well.
Professor, stay with us. We're going to continue to Bill Gross with Jens Nordvig joining us as well. Jeff Rosenberg, thank you so much.
Thanks,
a long day for you here at Bloomberg. Greatly appreciate it. With BlackRock. Stay with us. This is Bloomberg. Good afternoon, everyone. New York City, maybe not as sultry as it's been the last few days, but it is summer in New York. It was summer in Washington. Chair Yellen and team out with their Federal Open Market Committee report. We welcome all of you on Bloomberg Radio, Bloomberg Television worldwide. I'm Tom Keene. With me, Jay Weisenthal and S. Fu. I'll be speaking with Bill Gross of Janus Capital here at the 3 o'clock hour to not so much look at the meeting, but much more, Scarlett, to look forward.
To look forward and also talk about Bank of Japan, right?
Yeah, we'll talk a little. You're just fixing. You don't care about your Fed. You are un-American.
Are you accusing me of being un-American because I'm looking at the Bank of Japan? All right, let's look away from central banks for a moment and get the rest of the headlines on Bloomberg First Word News at this hour. Mark Crumpton has more from our newsroom. Mark?
Scarlett Fu with Tom Keene. How lucky are you? 8 years ago, they were rivals, but tonight President Obama will tell the nation why Hillary Clinton should be the next president of the United States. Mr. Obama will deliver the keynote speech in prime time for day day 3 of the Democratic National Convention in Philadelphia. He's hoping to cement his legacy by having a fellow Democrat succeed him in office. Donald Trump held a news conference in Florida this morning and didn't wait until tonight's speech to blast Mr. Obama.
I think President Obama has been the most ignorant president in our history. He has been a disaster as a president. He will go down as one of the worst presidents in the history of our country. It is a mess.
Also scheduled to speak tonight at the convention, Vice President Biden and Senator Tim Kaine, Secretary Clinton's running mate. A warning from FBI Director James Comey: hundreds of terrorists will seek to infiltrate Western Europe and the United States to carry out attacks as Islamic State is defeated in Syria. Speaking today in New York, Director Comey said he expects a, quote, terrorist diaspora out of Syria, adding that the future has already emerged in places like Brussels and Paris. He also said those attacks will be carried out on a wider scale. In France, one of the Islamic State supporters who stormed a church and killed an elderly priest yesterday reportedly was on a terror watch list. The Associated Press says he was forced to wear an electronic tag that let authorities track his movements. Police commandos shot and killed the 2 attackers. In Southern California, a state of emergency has been declared for 2 major wildfires burning in the state. The Fire Command says that the huge blaze in northern Los Angeles County is now 40% surrounded. 1 person was killed, 18 homes destroyed. In California's Big Sur region, 2 wildfires forced the state to close parks that attract thousands of visitors each day. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Mark Crumpton. This is Bloomberg. Scarlett, back to you.
Oh, Mark Crumpton, thank you so much. Again, we're talking about Bank of Japan. I was making a joke about it, but let's be clear. It is important what the Bank of Japan does in the next few days, and we'll have full coverage, particularly out of our Tokyo economics team. Let's look at the data. Green on the screen. The Dow up nicely. The 10-year yield lower. Joe and Jeff Rosenberg were talking about that. Lower yields here. That's a bit of a shock. Looking at oil, 41.97. The shock of getting near a 39 handle on oil. Quickly onto the second screen. A little more subtle here about what's going on. The 2-year yield was 0.76, now 0.73. 2-10 curve flattening, as Mr. Rosenberg noted. Yen 105.64, and gold boosts by $11. Scarlett?
And a quick breaking news headline here. Teva Pharmaceuticals wins U.S. approval, basically from the Federal Trade Commission, to buy Actavis after selling its generic business. So once again, Teva gets the blessings of the U.S. FTC to buy Actavis. And of course, we'll be following this one for you. Teva shares at 54.63, up 0.6%. 1%. All right, let's head now back to Washington, where our economics editor, Michael McKee, is standing by at the Federal Reserve. Mike, you broke the news for us that the FOMC did nothing with interest rates. It changed the language a little bit here, but of concern is what it does next with regard to the September meeting. And before then, we do get a couple of job reports. You're looking back at the labor picture here that the Fed will be contending with as it moves ahead towards September.
Yeah, well, they took the trouble to add the statement in there that the near-term risks had diminished. So what does that do? That takes us back to their forecasts for economic activity. The unemployment rate falling to 4.5% by the end of the year, and inflation rising towards their 2% goal. If we continue to get the kind of jobs numbers that we have seen for most of this year, we're going to be there. Well, why is that important? Because they said under those conditions they were going to raise rates by 1 or 2 times this year. So if we're seeing that in the jobs reports ahead in the beginning of August and the beginning of September, then they would be justified in raising rates, and so maybe the market starts to price that back in. Still with us is Narayana Kocherlakota. Until recently, he was a member of the Federal Open Market Committee and now at the University of Rochester. And Professor, let me ask you this. Do you see the economy justifying a rate increase, or at least the Fed trying to fulfill what its forecast is?
Yeah, well, Michael, if I were still on the FOMC, I think the employment picture, there's room for improvement there, but that's not where my main focus would be. My main focus would be on inflation. Are we really seeing the pushback to 2% that the committee wants to see? And are already seeing inflation expectations, longer-term inflation expectations, as measured, say, by those five-year break-evens. Are those stable? Are they really where we want them to be? And then you're trying to weigh all that against the international risks that could feed back and create a risk for the U.S. economy. So those are the factors you'd be weighing against each other. So the first order thing is really that inflation picture, and then always trying to as well assess those risks from overseas.
Well, if you wait until you see the whites of inflation's eyes, you're being reactive. Can the Fed afford to do that, or is it possible inflation will accelerate fast enough that you find yourself behind the curve? Used to be under Alan Greenspan, proactive was the model.
You know, I think that the key difference between that Fed, the Greenspan Fed, and the Yellen Fed is where you find yourself with respect to rates. That when you're near the zero lower bound, patience is really your byword. And so I think a strategy like the one that President Evans has called for, where you're waiting until you really see core inflation get back to 2% in a sustainable way, is really worth considering. And I should be careful. President Evans called for consideration of that strategy. I think it's really one that the committee should really think about very carefully.
You know, I look at it and maybe it's an overshoot. I pause there because I'm trying to figure out how you get an overshoot going if you can't get started. Professor, if we're going to talk about Rudiger Dornbusch in an overshoot, okay, fine. How much of an overshoot is an overshoot?
I think that if you, the big question for the Fed is really always about, are you aiming to overshoot or not? You might end up, you should end up, given the shocks that hit inflation. Inflation's affected by big shocks all the time, and the Fed can't control those things. So it's really about where the Fed is aiming. And really, if they look at the median of the committee's forecast for inflation under appropriate policy, they're really not aiming for an overshoot. Under the strategy I just described, where you're actually waiting for core inflation to get back to 2% in a stable, sustainable way before raising rates, then you would be aiming for an overshoot. My own assessment, given how sluggish inflation is, it would be by something like 25 basis points at most. So you get be aiming for 2.25 as opposed to 2. But you would be aiming for an overshoot.
Joe, that's critical what he just said there about 25 basis points, because that great chart you had on inflation, that takes you out to a service sector CPI of like 3.5%.
Right,
everything lifts up.
Dr. Kocher-Lakota, you talked about how it might make sense for the Fed to wait until they see realized inflation instead of just confidence that the inflation is going to get to their targets. Yeah. Do you think that's a strategy that's still on the cards, that they could seg into that strategy perhaps without it looking like they've made some sort of major reversal or backtracking of the approach they've taken?
I'm sure that everyone would like to be able to talk about the strategy going forward as if it's simply a continuation of what's happened in the past. I think that's going to be challenging, whatever the strategy actually is. If we go back to December of last year, a lot of confidence we're going to see 4 rate hikes, and that was really treated as the strategy. We're going to have 4 rate hikes, maybe 2. Maybe more if things go, maybe 3, maybe more if things go well. But it really was about treating that 4 rate hikes in 2016 as the benchmark. I think the Fed is really put itself in a situation where it has to really communicate more effectively about the factors that go into its decision making. I think my own assessment of those factors is weighing inflation against international global risks. And I think given how low rates are, given how close you are to the zero lower bound, they're likely to end up, my own forecast is they're likely to keep being patient until they really see the whites of inflation's eyes.
Okay, so the strategy for now is to keep being patient. You're known, of course, for your out-of-consensus views. You think perhaps that the Fed should perhaps even cut rates to better withstand potential shocks. What about the proposal that's been out there to raise rates in order to spur inflation further?
Yeah, I think that proposal is an interesting one in the academic context, and certainly there's been a lot of great debate about that in the academic world. I think it really relies on people's beliefs being shaped by interest rate hikes about where inflation is going to be in a way that we haven't seen in the U.S. data in the past. So I'd be very skeptical and very diffident about using such a strategy in real life policy circumstances. It's a great topic for us academics to talk about, though.
All right, thank you very much. Narayana Kocherlakota, former Minneapolis Fed president, now Bloomberg View column. Great to get your perspective. Up next on Bloomberg Radio and Television, currency expert Jens Nordvig, now at Exant Data, will weigh in on the Bank of Japan and Japan's possible stimulus package when we're next. This is Bloomberg. This is a special report, The Fed Decides, on Bloomberg Television and Radio. I'm Joe Weisenthal, along here with Scarlett Fu and Tom Keene. It's been a busy week for yen traders, but actually before we get to that, I want to, we're here with Jens Nordvig of Exanta Data. Thank you very much for joining us. Real quickly, we're going to talk BOJ, but was there anything in this Fed decision that jumped out to you?
Yeah, I think we knew that they're going to change the language on the economy, but they didn't know they're going to change the second paragraph, and they didn't have to. And they said that near-term risk to the economic outlook had diminished. So I think that really makes September a live meeting. They're less concerned about the outlook than they were in June. The dots they put down in June pointed to 1 or 2 hikes this year. So I think September is very much live now.
So what has to happen in order for Janet Yellen to signal in August at Jackson Hole that September is a potential go?
So we have 2 weeks of extremely important data coming out now, and if that data holds up, I think she will have to acknowledge that September is going to be a real discussion, and she's going to keep that on the table.
And when you say data, we're talking jobs data, really. Is that
jobs data?
Not all data is created
retail sales, I would say. Jobs data and retail sales.
All right, let's switch gears to Friday's big event. Scarlett's been making the case all week that the Fed is a snoozer. It's all about the Bank of Japan on Friday. If we go into the Bloomberg terminal, I want to bring up a chart of dollar-yen, 1 week implied volatility. It has surged to its highest level since 2008. If you're listening on radio, measure of risk seen to dollar-yen surging recently. It's a G #BTV2331. So clearly Scarlett's right because the market is looking for a lot of yen volatility here. What is it about Friday's meeting that there's just been so much weight put on it, so much anticipation?
Well, we've been through 6 months where we essentially came to the conclusion that the Bank of Japan was out of juice. There was nothing more they could do. And now we have this crazy idea of helicopter money actually being something that is perceived to be a realistic option. And the reason why this meeting is so important is that we can get a signal potentially whether we are moving in that direction. Like, if I visited the Bank of Japan like a year ago and mentioned helicopter money, they would say, like, we haven't even thought about it, right? So the fact that this is being considered in the market is pretty remarkable. So that's why it's such a big deal this week.
All right, so this chart that Joe shows talks about volatility or shows volatility. We know that monetary stimulus is yen negative. Is fiscal stimulus yen negative or yen positive?
It's normally you'd think, okay, you stimulate the economy on the fiscal side, you don't have to stimulate so much on the monetary side. So the key here is that it goes in the same direction at the same time. If that's the case, then it presumably could be quite inflationary over time, and that would be very much a push in terms of a weaker yen. So it's a little bit unusual because it goes hand in hand rather than opposite directions.
It always feels to me with the BOJ or Japan that they come up a little bit short of what people are excited about. So you're talking about the possibility that there could be some step toward helicopter money. What do you actually expect to happen, and how will the market react to it when that does happen?
Yes, I think Kuroda has been pretty clear that he is not a big fan of the idea. He's said it many times. A lot of people in the market do not trust Kuroda because he surprised the negative rates, and therefore they're very skeptical of putting too much weight on his promises. But I think this is a little bit different because he views it as being outside the BOJ's toolbox. But they can get there through the back door. If we have a big fiscal announcement from Abe's administration, and at the same time Kuroda buys more government bonds, it's not going to be an explicit announcement, but implicitly it's going to amount to the same thing. So the key for this BOJ meeting is whether they buy more bonds. If they do so, it's going to be seen as a signal that they're going down the helicopter path, essentially.
Okay, well, I'll go with that. Your wonderful book, your passionate book, The Fall of the Euro. You could make it The Fall of the Yen right now. You were way out front. Euro 140. We're now down at 110. Do you just assume, as the litmus paper of the system, that we see huge currency instability as various central banks react to their individual realities?
I think certainly if countries start to go down this helicopter path, you're going to see incredible currency instability. So the big question is, are we heading down that path, or are we sort of in a temporary
Olivier
equilibrium?
Blanchard calls it a scam. Do you agree?
Sorry?
Olivier Blanchard calls helicopter money a scam. Do you agree?
No, I don't think it's a scam. If you really have fiscal and monetary policy coordination, and it lets the fiscal authorities spend a heck of a lot more than they were otherwise able to do, then it's a big deal for the economy.
Do you have any faith in that?
So I have faith in the notion that if you increase fiscal spending enough, finance monetarily, you can get inflation. I have confidence in that.
Okay. Do you agree with Scarlett Fu that the BOJ meeting is more important than the Fed meeting?
If they do a big government bond expansion, it will be received as a signal in that direction,
Okay.
and that will be key.
You can stay because you agree with Scarlett Fu. That's
I win.
Jens Nordvig with us, Chief Executive Officer of Exante. Dave, of course, you knew him for years at Nomura as well. Coming up after the 3 o'clock moment, Wall Street time, on radio and television worldwide, my conversation with one William Gross of Janus. That'll be interesting. Yields lower today after a moderately hawkish Fed. Worldwide. This is Bloomberg.
Why are you so cheerful today?
I had a fantastic week trading my Interactive Brokers account. Wait, are you an active trader too?
I'm not, but I found a terrific financial advisor at Interactive Brokers Investors Marketplace. He manages my account. He built the perfect portfolio for me. Put me into a couple of hedge funds that are doing great.
How do you select the hedge funds?
They're listed at the Interactive Brokers Marketplace. You should look them up.
Learn more at interactivebrokers.com/IB Marketplace.
Good morning, everyone. Good afternoon as well. Wherever you are, it is Fed Day in America. No press conference. It's the first idea. We welcome all of you on Bloomberg Radio, Bloomberg Television. Of course, I'll be speaking with Bill Gross in a minute. Jens Nordvig with us right now with Exante, his first interview with Exante. We are honored that you are with us today. Let's wander over to the terminal. It's a slightly hawkish Fed. We've shown this chart too many times. We're only doing it to dazzle Joe Weisenthal. The 2-year yield with all the different Fed meetings, and the red circle was OMD, brutal moves, or OMG rather, we're all going to die. And then we rolled over with the Brexit rollover over on the right side. Janet Yellen wants to get back to the green circle. But, you know, Jens Nordvig, these are brutal moves. We're out 4 standard deviations on a recovering 2-year yield. Do you anticipate further instability when and if they act in September, or for that matter, into next year?
I think the key is that they have totally altered the notion of how quick they're going to go. So even if they deliver one in September or December, it's not going to be 4 per year.
This is critical. The vector isn't there. It's a one-move psychology.
Yeah, and I think that's crucial. And that allows them to go without worrying so much about, okay, is the yield curve totally going to reprice as a function of one move? And I think that's part of the reason why September is live. Now, even the move we're seeing in bonds, where we have bonds rallying, if you plug that into the Fed's model, that actually is a dovish impulse for them and would then make them even more likely to go.
Yeah, Joe Weisenthal, 4 basis points to a 1.5199.
All right, well, let's wrap up our thoughts here on this July Fed Day. Tom, we'll start with you.
Are we done? Can't we go another hour?
Sadly.
You have another 15 minutes with Bill Gross later on. How about that?
Yeah, my thought, I took this from Game of Thrones, it's a many-theoried Fed. And frankly, Jens Nordvig is the most important guy in the room, because when you have too many theories out there, is theory the word? The many-theoried Fed, there's a lot of theories going on, and that leads me to instability expressed in Jens Nordvig's market.
All right, and
where you're ultimately going to see it.
The Many-Theoried Fed by Tom Tyrion Lannister Keene. Let's go now to Bloomberg's Mike McKee over at the FOMC. Mike, what are your final thoughts?
Well, the Fed can say whatever it wants, and the first paragraph of the statement was stating the obvious. The economy is better than it was in June. But for them to have inserted a line saying near-term risks had diminished in the second paragraph was a distinct message, because they never said there were near-term risks rising in June. The market said that. So they're trying to tell people, look, we're not out of the game. Don't price us completely out for September. Don't price us completely out for December. We're still open to moving if the data tell us to do that.
Still data dependent, Joe.
The thing that really stuck out to me is that answer from Jeffrey Rosenberg about the challenge of portfolio management in this environment. If you have equities and bonds moving in the same direction every day, as we've seen on the up days and the down days, and you have a portfolio premised on the idea that they're going to hedge each other, what do you do?
Where do you go from there?
Yeah, what do you do? How do you get any sort of diversification? You're just at the whims of the changing expectations about the Fed.
Which is why you go farther out in terms of risk,
right,
because that's the only way you can get some return. All right, well, my takeaway is pretty simple, and I'm going to basically parrot Jens Nordvig here. September is totally live, because the Fed did change the second paragraph when they didn't have to. They added this idea that the near-term risks to the economy have diminished. And we've seen how that jobs report for the month of June totally changed the picture here. Are you comfortable, Jens, with the idea that the May jobs report was just an anomaly?
Yeah, we spent a lot of time looking at proprietary indicators of the labor market, and there's nothing that really signals where we've shifted down materially. So I think April and May was noise mostly at this point.
Very quickly, why are yields lower today?
I think it's a part of the global trend. So you can see what's happening in the UK bond market, a lot lower today, like Italian bonds are rallying.
Okay.
So it's this global factor that's dragging them down, as I see it.
Okay.
Global factors. Some might even say that the Fed doesn't control rates. It's all controlled by central banks overseas. All right, Bloomberg's Michael McKee, thank you for joining us from the Federal Reserve, and Jens Nordvig of Exante Data, thank you so much. His first interview with Exante. That wraps it up for Bloomberg's special report, The Fed Decides. Stay tuned on Bloomberg Television and Radio, because Tom will be sitting down with Janus Capital's Bill Gross in just a couple of minutes. They'll discuss the Fed, what it did, the maximum optionality, and of course, the Bank of Japan and helicopter money. Don't miss that interview. This is Bloomberg.
It's 3 p.m. in New York, 8 p.m. in London, and 3 a.m. in Hong Kong. Welcome to Bloomberg Markets. From Bloomberg World Headquarters in New York. Good afternoon, I'm Bonnie Quinn, and here's what we're watching this hour. The Fed leaves interest rates unchanged, but does say the risks to the U.S. economy have somewhat diminished. Bond king Bill Gross of Janus Capital joins in just minutes. Plus, President Obama's economy has left behind the voter coalition that Hillary Clinton wants. What kind of challenge will that pose in November? And Facebook earnings out after the market closed today. We look at how Instagram and video are driving Facebook sales on mobile. We're 1 hour from the close of trading. Let's head straight to the markets desk. Julie Hyman is keeping an eye on things. Pre and post FOMC.
Pre and post FOMC for stocks does not look that different, but if you look at different assets, it does. Yes, the Dow is up a little more than it was before the statement, up 32 points right now. The S&P little change, and the Nasdaq up about 0.6%. It's been leading the pack today because of Apple. But let's take a look at the 10-year note. Now, what we have seen is a bit of a contrary reaction. In other words, you got here a fairly benign Fed statement in terms of economic growth in the United States, and so one would think that we would have seen an increase in yields, and yet that's not the case. We're seeing an acceleration of decline in yields as we saw more buying of the 10-year Treasury, 1.51% there. Similar movement in the U.S. dollar, the Bloomberg Dollar Index moving lower in the wake of the Fed's statement. If we can take a look at that dollar index, you saw declines there for it. There you go. So first spiking up, and then coming down, and right now it's little change. Likewise, you can take a look at WIRP on the Bloomberg, which looks at Fed funds futures to price in the probability of interest rate changes. And in particular, I'm paying attention to the December meeting here. So right now we're at 46.3%. Here you have it expressed in graph terms. And so essentially you've seen a little bit of sideways movement. It's even come down a little bit, the probability for an increase at the December meeting. It went as high as 50% in the wake of the statement, and now coming back down.
Julie, thanks. Let's get more reaction to today's Fed announcement now. Bloomberg surveillance anchor Tom Keene joins us with a special guest. Tom.
Vonnie, thanks so much. William Gross is with Janus Capital. We welcome all of you on Bloomberg Radio, on Bloomberg Television. William Gross has been unconstrained, which has been a tough battle given the back and forth and the cross currents of what's going on. Bill, I want to congratulate you on even surviving to the end of the work given what's going on. What's the biggest challenge of managing money given global central bank theory?
Well, the fact, Tom, and thank you for the compliment, we're up 4% for the year, and so I'll take that for 2/3 of a year. But the biggest challenge is obviously, what the central banks are doing in terms of producing near 0% interest rates, and in many cases negative interest rates, and the judging going forward of what they may continue to do. We know that the BOJ on Thursday night will probably have a special surprise for us, and we know with near 100% certainty that the MPC in the UK will initiate some program in August, and so yields move lower and lower and lower to near unfathomable types of levels. The trick is to know when they stop and to get out before the music stops.
I want to get to helicopter money in a minute, but this is important. All of our viewers and listeners, whatever their walk of life, are certain that we see a great distortion in Bill Gross's world. You have said this will go on for years. Rogoff, Reinhart, Gross have all said the duration of this distortion is remarkable. Do you see any indication it ends anytime soon?
Well, no, not yet, because the objective of central banks is to produce not only real growth, but nominal growth, and that's why we hear about inflation all of the time, certainly from Japan and from the ECB. Countries and global economies need nominal growth in my opinion, 3 to 4 to 5% in order to pay bills that were incurred over the prior 5, 10, 15 years. So the objective is, a 4 to 5% nominal rate of growth, and we won't see higher interest rates until we get to that level. We may never get to that level based upon, some of the current conditions in terms of productivity and economic growth forecasts going forward in real terms that are 1 to 2% at best in the United States. But we'll have to see. If they don't succeed at generating nominal GDP growth, Tom, they're going to stay where they are.
Right. When you look at this bill, one of the basic rules is you have to clear markets. Back to Friedrich Hayek in the 1940s, you've got to clear markets. We see Deutsche Bank struggling with clearing out their challenges. We can look at the entire economy of Japan as another example. If we are reticent to take the tough medicine, what institution is going to drive that debate forward? Or is it just the market vigilantes, the bond vigilantes like Bill Gross, that's going to tell the authorities when to clear markets?
Well, markets, to my way of thinking, are a function, yes, of monetary policy, and that's what we talked about for the last few minutes, but also of fiscal policy, and together they come together to generate nominal GDP. I think monetary policy has gone about as far as it can go, and bond vigilantes are certainly not a factor in driving the forward-looking behavior of Mario Draghi or Janet Yellen. So going forward, and I think we're beginning to see this, Tom. We see this with in Japan, and we see it in China, and we see a little bit of it in the political atmosphere here in the United States during the conventions. Fiscal stimulus lies ahead, and the combination of monetary as it is now, and perhaps more fiscal stimulus going forward, it is something that we should look forward to, I think.
Bill, I think when you were clipping coupons, rather, not licking postage stamps, you did that later, but when you were clipping coupons in the PIMCO mailroom a few years ago, you dreamed about owning a helicopter. We all may get it with helicopter money. Olivier Blanchard says it's a scam. Other people are more calm about it. Where do you fit in here? Do you think helicopter money as a fiscal proxy can work?
I think it is a fiscal proxy, and that's a good phrasing of what helicopter money is. People view it as dropping actual cash to citizens, from helicopters, and that's really not the way it works. It works through fiscal policy. So to the extent that helicopter money, generates some type of fiscal stimulus, Keynesian fiscal stimulus, I think it's a positive. I would not claim that where we are now in terms of monetary policy and the combination of 0% interest rates and the thrust of helicopters going forward is really a positive for capitalism, because it's not. We have to get off of this addiction, at some point, because capitalism, to my way of thinking, cannot thrive. It may survive, but it can't thrive at 0% interest rates, because the savings function, which ultimately leads to the investment function, is destroyed.
When we do this, and when we get back to the beginning of normal, do you assume smooth glide paths, measured vectors where you and Janice can work in real time to adapt and adjust, or do you just assume it's some brutal jump conditions?
I would favor the latter, although I don't know, and I would hope for the former. But I think while the adjustment going down in terms of yields has been rather gradual over the past 5 or 6 or 7 years, I would think some type of step function on the other side would probably be the norm. A step function, not necessarily in terms of interest rates, because they're still going to be controlled by central banks, but a step function in terms of risk assets and the desertion of the investment market from them.
What would be your advice to Chair Yellen? What we've certainly seen in the last number of days is good corporate earnings. I think of United Technologies, DuPont, even McDonald's with their struggles doing okay, Apple doing okay according to the surveillance interviews we did today. It's a pretty good America, and yet she's central banker to this troubled world. What would be your counsel to her for September and then into next year?
Well, I would suggest, and perhaps we're going to see some of this in August, Tom. You'll probably be out there at Jackson Hole, and we'll hear something more. But, you know, I think Janet Yellen, not to be critical, but you're asking me, and so I will be. You know, as well as all central bankers are fixated on the fact that the lower and lower interest rates go, the higher and higher asset prices go, and ultimately that redounds to the benefit of the real economy. I don't think it does, and so I'd say, Janet, get off of it. You know, get off of this fixation of lower interest rates providing a push for economic growth, because the evidence is, despite what you talked about in terms of Apple and corporate profits, the evidence is that nominal GDP has only grown by 3.3% over the past several years, and real growth is down below 2%. And so, you know, that is not normal. Something must be wrong. And so get off of your old model and get into the real world of common sense.
Right. Here's my real world, Bill Gross. I need some financial advice, and you're the only one that's going to give it to me. Is dividend growth a proxy for yield?
For high yield, it can be, because, you know, dividends, although we don't believe it, are subject to reduction as well as increase. But a dividend yield relative to a risk asset with a 30-year duration is a decent proxy, yes.
Bill Gross, thank you so much. Greatly appreciate it with Janice, and congratulations on the your performance of your unconstrained fund as well. Vonnie?
Coming up on Bloomberg Markets, we're going to be at the DNC in Philadelphia. Hillary Clinton becoming the first woman nominated. We'll be speaking about economic policies and can she win the support of disenfranchised voters. This is Bloomberg Markets. I'm Vonnie Quinn. Now let's get a check of the headlines on the Bloomberg First Word News this afternoon is Mark Crompton. Mark.
Vonnie, the Democratic National Committee was warned last fall that its computer network was susceptible to attacks, but it didn't follow the security advice it was given. That's according to people familiar with the matter. The theft and recent public disclosure of thousands of email messages have disrupted the party's convention and led to the resignation of Chairwoman Debbie Wasserman Schultz. Tonight, President President Obama will tell America why Hillary Clinton should succeed him in the White House. The president's speech comes a day after Democrats formally nominated Mrs. Clinton at the convention in Philadelphia. In an interview with NBC's Today Show, the president said the choice between Mrs. Clinton and Republican nominee Donald Trump is clear.
What I think is scary is a president who doesn't know their stuff and doesn't seem to have an interest in learning what they don't know.
The president also said Mr. Trump is someone who likes attention, and he may have surprised himself by getting this far. German Chancellor Angela Merkel is facing renewed criticism over her handling of the refugee crisis. Lawmakers from her coalition argue that 4 attacks in Germany in the past week show that Merkel's refugee policies aren't working. 3 of the attacks involved refugees, although none had arrived in the last year. Ukraine wants to put a radioactive wasteland into the solar energy business. The country wants investors to develop solar power near the ruined nuclear reactors at Chernobyl. The radioactivity from the 1986 meltdown made the area uninhabitable, but officials say it would be great for renewable energy because the land is cheap and there are already high voltage transmission lines. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Mark Crumpton. This is Bloomberg. Vani, back to you.
Mark, thanks. President Obama will take to the podium at the Democratic National Convention tonight and make the case that Hillary Clinton should be the next president of the United States. Getting the support of young and minority voters will be crucial for Clinton, though. And those 2 groups have lagged in the economic recovery under President Obama. Bloomberg's Toulouse Olorunnipa has been reporting on this story and joins us now from the Wells Fargo Center in Philadelphia, the site of the Democratic National Convention. Toulouse, what have you been learning about how these young and minority potential voters have fared in the last 4 to 8 years?
Well, these voters are going to be absolutely key if Hillary Clinton is going to be the next president. They helped to propel President Obama in 2008 and 2012 to victory in his historic candidacy. And if Hillary Clinton is going to win, she's going to need these very same voters. Now, these voters have struggled in the Obama recovery. They've lagged behind. Minorities have lost wealth, even as the broader economy has gotten better. So it's going to be difficult for Hillary Clinton to run on President Obama's economic record, specifically targeting these voters. She's going to have to offer a little bit more.
Terrifying statistics in your story. One is that the median net worth for black households fell to $11,000 in 2013, a 33% drop. Median wealth for Hispanics was down 14% to $16,000. Non-Hispanic whites saw a 2.4% increase to $141,900. Now, you also visited a center in Queens where people were trying to get voters to turn out for Hillary. It was empty. Do these people turn out? What's Hillary offering them?
Yeah, those numbers you mentioned are pretty stark. Even before the recession, there was a huge wealth gap between the various races, and it got much worse during the recession. And even after the economy started to rebound, we saw that minorities continued to suffer a loss in wealth. And Republicans put out a report after 2012 saying that they need to reach out to these voters, and they've tried to do that, but with Donald Trump at the top of the ticket, it's a little bit difficult as he's offending a lot of the very voters that Republicans believe they need in order to win this election.
Does Donald Trump think he doesn't need these voters, or does he think he can win them over some other way?
Well, he says that he's not going to pander to any specific group, and he's going to avoid political correctness and tell it like it is. He believes that will appeal to a broad group. He is making a play specifically to sort of the down-and-out white working-class voters. He's believing that appealing to them and getting them to turn out in large numbers will help make up for what are historic gaps and historic negative ratings that he has with minorities, specifically Hispanics. You know, he said he's wanted to build a wall between Mexico and the U.S., and that's turned off a lot of Hispanic voters against him.
Well, Donald Trump spoke today about Hillary Clinton's emails, and that's causing some controversy this afternoon. Let's have a listen to what Trump said.
Russia, if you're listening, I hope you're able to find the 30,000 emails that are missing. I think you will probably be rewarded mightily by our press.
Now, the Clinton camp responded by saying, quote, "This has to be the first time that a major presidential candidate has actively encouraged a foreign power to conduct espionage against his political opponent." Toulouse, how big an issue is this becoming?
Yeah, it was quite a bizarre statement from Donald Trump, basically inviting the Russians to hack Hillary Clinton's emails and give the information over to the U.S. It's something that the Hillary campaign is going to play up tonight. Their theme for the night is national security. They want to make the case that Donald Trump is unsteady, that every day he makes another comment that makes you scratch your head or makes you wonder whose side he's on. And that's something they're going to play up during tonight. And Donald Trump's statements today sort of played directly into that theme. We'll definitely hear from that perspective tonight here in Philadelphia.
Toulouse Olorunnipa at the DNC at the Wells Fargo Center in Philadelphia, gaveling in not that long, not even an hour from now. All right, still ahead on Bloomberg Markets. Pfizer reports earnings next Tuesday. Expectations are high after last quarter's results. Shares are up 14% year to date. So in today's Options Insight, we'll explore how to take advantage of any potential further upside. This is Bloomberg.
Hey. Sorry to be late. Did you hear about the NATO plane downed by Russia?
No.
Markets are a mess. Everybody's selling, or at least trying to, if their brokers are up and running.
But it's almost 8. Everything's closed.
That depends who your broker is. I can trade in Chicago, London, Hong Kong, right now. Wow. The market's already down 2%. I'm sorry, I need to do some hedging trades.
You want to trade here, right now?
Yeah, it'll just take a minute.
Wow. Who's your broker?
This is Bloomberg Markets. I'm Bonnie Quinn. It's time now for Options Insight with Julie Hyman. Julie.
Thank you, Vonnie. And joining me for today's Options Insight is Dan Deming. He's manager at KKM Financial. He's joining me from the CBOE out in Chicago. So, Dan, first I want to talk about the Fed today. Of course, not raising rates, but coming out with a statement that seemed to be relatively optimistic about the U.S. economy. And yet, in the wake of it, we actually saw yields fall further on the 10-year. We saw the VIX fall lower, for example. I'm just curious what you're seeing in options that explains any of this activity that we've been seeing.
Well, you know, Julie, like you said, it was a fairly benign statement. The fact that they diminished the short-term risk, I think, is seen as a positive. That's why we saw this market able to find some stability and gravitate back towards unchanged here. And the options market's reacting very quickly to that type of news item. And we saw volatility elevated a little bit this morning, but the hint that we saw some stability in the market has brought volatility expectations lower. Like you said, the VIX is now lower. And you're just seeing a lot of really not too much determination as far as price movement in underlying equities and indexes, so that's why you're seeing option volume and option pricing coming in right now. I think we're getting down to the end of this month. August, historically, in the last several years, has been a little bit more of a volatile month, but currently, in the short order, volatility seems to be somewhat subdued and not seeing any significant pickup here for the next week or so.
You know, I'm curious. You talk about no volatility change really in the next week or so, or pickup, but we do have a lot coming down the pike, right? We've got the Bank of Japan, we've got the Bank of England next week, we've got the latest revision of second quarter GDP coming Friday, we've got the jobs report next Friday. Do you think that the market's just going to kind of shrug all of that off?
Well, I think right now the focus is on earnings, Julie, and we're kind of seeing a culmination right now of pretty moderate earnings, some surprises on the upside, certainly some disappointments as well. But overall, the market, again, got through this hurdle today with really very limited reaction. And I think when you look at the volatility expectations, when the market gets through something like this and you don't see too much of a reaction, that kind of puts option players, vol players, you know, a little bit at ease as we move through some of these other numbers, because really this was viewed as a pretty big hurdle, and the market made it through with relatively unscathed.
Gotcha. Let's get to earnings then, because your trade today has to do with a company that's going to be reporting next week. It's Pfizer.
Right.
We haven't heard from a lot of the big drug makers so far. I believe we heard from Eli Lilly and Gilead, for example, more on the biotech side. And so what are you looking at here? Because you're looking at actually a further dated call. You're looking out to October. Walk me through what you're doing here.
Yeah, I'm looking at synthetically getting long this stock, Julie, and what I mean by that is I'm looking at a risk reversal, so out till October. I think, you know, like you said, some of these news items, Pfizer has had a significant run up from the last quarter. Some of the trends, the revenue trends look positive moving forward. The margin trends look positive moving forward. So these things, I think, have been priced into this stock. I think it's gotten possibly a little bit ahead of itself. Couple that with the fact that in the last several years we have seen some weakness in August, that I just don't want to get long the stock, but I can get synthetically long the stock by buying an out-of-the-money call in October and selling an out-of-the-money put. And it allows me to collect a little premium while I wait for the opportunity to pick up this stock just below 35. And if it takes off from these levels, we push through 38, I've got that high side call that's going to participate to the upside.
All right, Dan Deming, got to leave it there. We'll be watching for those Pfizer earnings next week. Thank you so much. Appreciate it. That's Dan Deming of KKM Financial joining us from the CBOE. Bonnie?
Julie, thanks. And still ahead on Bloomberg Markets, the Fed didn't act this time around, but our next guest, Tim Dye of the University of Oregon, will give us his take on how long that might last. Having a look at the majors, the Dow is up 0.2%, 32 points. The S&P 500 is unchanged pretty much. The Nasdaq is up 0.7%. Not too much movement after the FOMC statement. This is Bloomberg.
Bloomberg's world headquarters in Midtown Manhattan, you are watching Bloomberg Markets. I'm Scarlett Fu.
I'm Joe Weisenthal.
And I'm Amanda Lang.
Let's begin with a check of the headlines on Bloomberg First Word News this afternoon. Mark Crumpton has more from our newsroom. Mark?
Scarlett, Hillary Clinton won't be changing her opposition to that controversial Trans-Pacific trade deal. Her campaign chairman, John Podesta, rejected suggestions Mrs. Clinton may soften her position after the election.
I can be definitive. She is against it before the election and after the election. She has a long economic agenda that includes investing in infrastructure, in enforcing our trade laws, in raising the minimum wage, in fighting for the right to organize, in making sure that college is affordable. And she is not interested in renegotiating the TPP.
Mrs. Clinton helped negotiate the trade deal while she was Secretary of State. President Obama is increasing the number of refugees who will be let in from Central America. The program is aimed at those fleeing dangerous conditions. It will allow some older siblings, parents, and other relatives to be eligible when they apply to enter the U.S. with minors. The Obama administration has come under attack for deporting Central Americans who entered the U.S. illegally. The daughter of President Ronald Reagan is criticizing a judge's decision to grant freedom to John Hinckley Jr., the man who shot the president and 3 others in Washington 35 years ago. On her website, Patty Davis says she will, quote, forever be haunted by the day her father nearly died in 1981, and that her, quote, heart is sickened by the decision. A jury found Hinckley not guilty by reason of insanity. Once he's released from a government psychiatric hospital, he'll live with his mother in Williamsburg, Virginia. Turkey's state-run news agency says close to 1,700 officers have been formally discharged from the military following the country's failed coup. Anadolu news agency also says the government has decided to close dozens of media organizations, including 45 newspapers and 16 television stations. The government says a U.S.-backed Muslim cleric is behind the failed uprising by a faction within the military that led to some 290 deaths on July 15th. Global News Agents, Global News 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Mark Crumpton. This is Bloomberg. Amanda, back to you.
Thanks, Mark. Well, markets close in under 30 minutes in New York. We go live to the NASDAQ, where Abigail Doolittle has been watching the action. Abigail?
So, Amanda, we have a very nice rally on our hands here for the NASDAQ, up about 0.7%. In fact, the NASDAQ is on pace for its first 2-day rally in 12 sessions. And of course, today's bullish action is all about Apple. The iPhone maker is having its best day in more than 2 years. This after the company put up a better than expected June quarter, beating earnings estimates, revenue estimates, and iPhone unit estimates for that June quarter. They also guided revenues higher for the September quarter. But we're left with a sort of odd tension here, Amanda, because all those figures, they actually represent pretty decent year-over-year declines. That tension could be solved, if you will, when we find out more about the upgrade cycle around the iPhone 7 later this year. Turning to what could really influence the NASDAQ tomorrow, Facebook, the social media giant, does report today after the close. And there are 2 things that really stand out here, Amanda. First, can Facebook beat again? They have beaten earnings estimates 8 out of the last 8 quarters. Second, there are a lot of moving pieces here to pay attention to. By moving pieces, I mean metrics. Relative to adjusted earnings, the street is looking for 82 cents on a little more than $6 billion in revenues. They're expecting mobile advertising revenue to be 82.6% of total revenues. Monthly average users will be important too. The street is calling for that to come in at 1.69 billion. We did reach out to James Chakmak, an analyst at Monness Crespi, earlier today, and he adds 2 more metrics to this pile: engagement and pricing growth. On engagement, he says anything above 60% will be positive, and for pricing growth, he says that anything that is up will also be a positive. He is bullish. James Chakmak is bullish going into the Facebook quarter, reported after the close in just a few minutes, Amanda.
Yeah, we'll be watching that and, of course, reporting it as soon as possible. What else is on deck tomorrow in this heavy earnings season that could affect the NASDAQ?
Well, for that, we turn to biotech, Amgen. This is the biggest member weighting of the NASDAQ Biotech Index, and the company is reporting today after the close. Investors are looking for adjusted earnings of $2.74 on $5.8 billion. Another company that has beaten 8 out of the 8 last quarters relative to earnings. And Bloomberg Intelligence analyst Astika Gunwardena, who correctly called Gilead Sciences missing earlier this week, he says he wouldn't be surprised to see this company beat once again, really driven by a combination of cost-cutting plus strength in the company's chronic disease drug. Now, a potential beat here could be very important, Amanda. Again, Amgen is the biggest member weighting to the NASDAQ Biotech Index. And when we go into the Bloomberg and we take a look at a one-year chart of the biotech index, we see a brutal bear market, down 40% peak to trough. But over the last few days, we see something very interesting, and that is the fact that the biotech index is starting to peak above the trend line marking that bear market, suggesting that perhaps we're starting to see the early signs of a reversal. And for viewers who would like to take a look at that G chart, they can do so by going into the Bloomberg G #BTV 2336. Love those G charts, Amanda.
Love them too. Abigail Doolittle at the NASDAQ. Thanks.
So the Fed didn't raise rates today, but the time may still be coming soon for them to act. Our next guest points out that inflation measures have been slowly converging on the Fed's 2% goal. We're looking at a chart here of 3-month, 1 month annualized core PCE and 12-month. With us now is Tim Doi, professor of practice and senior director of the Oregon Economic Forum at the University of Oregon. Tim, thank you very much for joining us. So you recently wrote that the doves aren't going to be able to hold off a rate hike for too long. Did anything in today's statement change your view at all?
Well, no, we did have that little bit of a push with the reduction of those near-term risks, but that's, I think, a fairly small move toward, a rate hike. Still, we're really looking for, I think, continuation of the solid data that we've seen and stronger inflation numbers, which I don't think are would not be completely unexpected at this point.
It's also not unanimous. You had Esther George dissenting, for instance. Would it be helpful to the debate within the Fed for there to be more dissent?
Oh, I definitely think that it would be nice to see dissenting voices on both sides of the coin, though. Not only the issue of whether they're going to hike rates, but also maybe we should have seen some dissents last December when they did, in fact, rate hikes, because that might have been a premature action.
So as we look at the language, which is what they've left us with in terms of guidance, they did. You've noted that what the doves need to see is the labor market utilization rates pick up. There was a nod to all of that, Tim. Is that enough to suggest to you that we're moving sooner than we might have thought?
Well, I think it's enough to suggest that that's clearly on the horizon, that there's a possibility of raising raising rates in September. 1 or 2 solid employment reports like we've seen, continuation of a downward trend in unemployment. If we end up getting those inflation numbers looking like they're going to hit 2% toward the end of the year, then September will become a much more interesting meeting. If we get inflation to 2% by the end of the year, then we'd be closer to Charles Evans's point of view that we should just wait until then before we even hike rates. So it's completely foreseeable that by the end of this year we could see the conditions in place for the Fed to move forward with a rate hike if they so desire.
Okay, well, in terms of tightening policy overall, you propose that there's another way the Fed could achieve that, perhaps using its balance sheet as one way to tighten monetary policy, and that this too could happen by the end of the year. What kind of changes specifically could or should the Fed consider making to its asset holdings?
Right, and this is, I think, a concern that many of us have when we look at the bond market and see the yield curve flattening and start to worry that really the Fed doesn't have much room to raise rates. But what happens should they really desire to tighten policy? What's the appropriate action? And I've sort of followed through on some thoughts that Governor Dan Tarullo suggested, and that's maybe we don't want to raise rates to the short end. Well, if we're not going to do that, maybe we need a different policy. And I suggested that maybe we should look at the balance sheet and letting some of our assets mature off the balance sheet, or sell some of those assets off the balance sheet in order to tighten policy rather than focusing on the interest rates.
Yeah, to that point, I just wanted to bring up from the Bloomberg a look at the 210 spread. This issue of the flattening yield curve, it continues to flatten. Just a few days ago, it was over 90 basis points, back down to 78 basis points. But I want to ask you about the Fed's data dependence. And one thing that's striking over the last several months is how big that May jobs report miss stands out as something that really seemed to have thrown everyone off course. Let's say the data continues to look fine. We continue to get these beats, labor market's fine. Then we get a August jobs report, say, and it's another sort of unexpectedly weak report. With the way the Fed's going, does that just set us back to zero again? Is the Fed so sensitive to any one report that destroys all progress, one bad report?
Well, effectively, yes. I think the concern here is that if you go back over the past year or two and seen how low interest rates were over that period of time, the Feds would have said, oh, by the time we get to 2016, things should be just exploding if we don't raise rates. But then we get to 2016 and we don't have a situation where the economy is exploding upward. We see a lot of choppy data, and that would, I think, feed into the Fed's concerns that this is not an opportune for time for a rate hike. So I think you do need to see fairly solid, consistent data going forward in order to justify, to prompt the Fed into hiking rates.
So one of the things that we've been told over time, of course, Tim, and I'd be curious for your take on it, is the shadow Fed funds rate. We can go into the terminal and take a look at that. This is a theoretical measure, of course, and it's a combination of sort of what they do with their balance sheet, but also policy direction. But based on the shadow Fed funds rate, we've seen an increase of close to 3% off of a negative base. Is that enough? Is that where you might see a continuation that might start to move that 10-year, if the Fed is focused on the 10-year, it might start to move the long end of the curve?
Well, if I remember correctly on how that rate is constructed, it basically isn't being used now since the Fed funds rate is in positive territory. But I think that, yes, in general, the idea here is that if the Fed were to try to sell off some of its balance sheet, you'd probably want to see the curve steepen or shift up as a policy response rather than seeing it flatten or invert as the Fed seems to be headed toward now.
All right, Tim Dye, professor of practice and senior director of the Oregon Economic Forum at the University of Oregon. Thank you very much for joining us.
Coming up on Bloomberg Markets, Facebook reports in just over 20 minutes. We're going to take a look at how the social media company plans to compete for user attention as well as advertising dollars. This is Bloomberg. is Bloomberg Markets. I'm Scarlett Food. It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. The U.S. Federal Trade Commission has approved Teva Pharmaceuticals' $40.5 billion purchase of Allergan's generic drug-making unit. This after the companies agreed to divest certain drugs to preserve competition in the pharmaceutical market. Teva agreed to buy the business in a cash and stock bid last year. SAB Miller is suspending work on integrating its operations with those of Sutter Anheuser-Busch InBev. That's according to a person familiar with the matter who says SAB Miller management sent the request to employees. Both beer makers declined to comment. Shares of Molson Coors Brewing falling on the news. The U.S. brewer is set to acquire SAB Miller's stake in the Miller Coors Brewing venture as part of the deal, which still needs approval from Chinese regulators. Forrest Mars Jr., the billionaire co-owner of Mars Inc., has passed away. He helped oversee the U.S. candy maker's global drive into new markets for M&M's, Milky Way bars, and Uncle Ben's rice. According to the Bloomberg Billionaires Index, Mars Jr. was the world's 21st wealthiest person, amassing a net worth of $31.5 billion. Forrest Mars Jr. was 84 years old. The owners of SoundCloud are considering a sale that could value the German music streaming company at $1 billion. That's according to people familiar with the matter. SoundCloud's founders and investors, including investment firm Dowdy, Hanson & Company, are exploring strategic options for the company that could lead to a sale. And that is your Business Flash update.
Facebook reports earnings today at 4 p.m. Investors are likely to be happy. The stock has more than tripled since its IPO. The big question, though, is whether the company's mobile revenue growth and user engagement will keep investors happy. With us for a preview is Bloomberg's Corey Johnson. Corey, I guess I want to start with what you're most closely watching, because there are a couple of metrics that we know the analyst community is looking at. What's the most important?
I'm not looking at mobile as much as a lot of other people are. But Facebook, is to be commended is not the right word. I mean, when they went public not too many years ago, they had zero in mobile revenues. Now they're doing upwards of 80% of other revenues in mobile. So mobile obviously is very huge for them. But I think that's a slow transformation we expect to continue. What I'm really looking for is the pace of user growth, which has actually accelerated in the last couple of quarters. It was kind of a shocker because it's so big already. And the revenue growth per ad. What we saw from Twitter this week is that Twitter's unable to monetize in video ads. As more and more ads are in video, they're not getting so much revenue from those ads. A great disappointment for Twitter. So I wonder, does Facebook, Twitter sort of cited their lack of technology around video ads and the measurability of video ads. So I wonder if the real advantage here isn't for the company to look at, the real advantage of Facebook might show up in the way that their advertisers can look at the ads and video ads and see how well they're doing.
Corey, yesterday we talked to Andrew Left of Citron Research, who's one of the few bears on the stock. And let's listen to what he had to say about what would cause him anxiety. Yes.
All right, Andy, what do we got?
Yes, they are moving in. They will have to own everything mobile, all the engagement. There is a finite amount of advertising out there, but that's a whole nother category for it.
So his argument is essentially that to justify Facebook's current valuation, everything on mobile has to be Facebook. And so when you see the rise of a Pokemon Go and all the attention that sucks up, that shows that there's a vulnerability there, that people could shift elsewhere. On this engagement question, where should we watch? And what is the key metric that would be an early warning that engagement is starting to tail off?
So there's a number that I've been tracking since the very first days of the IPO, which is the comparison of monthly active users to daily active users. That is not just the audience that Facebook has, some people who are on it once in a while, but the people who have to be on it every day. And what's really interesting is Facebook has very steadily converted those people. It's not, you might expect the number to be flat, that some people are just regular Facebook users, other people just check it once in a while, see what's going on. No, you've seen a tremendous increase of Facebook daily active users as a percentage of monthly active users. You might call that engagement, you might call that a conversion rate. I call it conversion rate. I think other people on the street call it engagement. But it's just a fascinating number, and it's been getting better and better and better for Facebook the entire time they've been public.
And how is that tied into how effective Facebook is with marketers? Because we know that Facebook is touted as this company that can offer companies very, very specific marketing opportunities. But do we have a way of measuring whether that's actually happening?
More anecdotally, I think, than anything else. As far as looking at the numbers, I mean, the one number that shows that, right, is the revenue per ad and the success that they've had with that and how much better that gets. That says to me advertisers are willing to pay for that. But anecdotally, when we talk to advertisers, we hear that they love this service and they are directing ad dollars towards Facebook, towards Snapchat, towards Google, And those are really the big winners online right now.
It's interesting that you talk about the daily user as a percentage of monthly, because a VC told me not long ago that is the single most important metric he's watching on a new app or a new site.
Oh, I got one right. That's one in a row now.
I mean, out of the park there, Corey. But in terms of Facebook and that and how it turns to video, live video is going to be important, and monetizing live video is going to be important. Are you hoping to see something this quarter that gives some indication about how that's doing? Or
they've been talking about a lot in the conference calls for the last year or so. So is Yahoo, for that matter. I think that may be one of the secret gems within the Yahoo acquisition by Verizon is the ability to measure video. I knew that was an asset, but I recognize it more having heard the Twitter conference call. So I think it's an interesting thing to watch here. I think the other thing that'd be interesting to listen to is what they say about Instagram and monetization in Instagram. We know that that's been increasing a little bit. I don't know if you guys see that in your Instagram feeds with more and more ads showing up there. This was an ad for Medium not too long ago.
Yeah.
And I enjoy the anecdotal, but we see it happening. We know they've been talking about it. I wonder if we'll hear more commentary about that tonight.
If we could just go into the Bloomberg while we were talking there, I whipped up a chart of daily active users as a ratio of monthly active users, and it's actually at 65%. Does people think that could keep climbing?
I mean, the trend is their friend, right?
Right. It's been since they've been public. It's just been going up.
And this also counters the argument that Facebook is for grandparents, right? And that the cool kids aren't on Facebook anymore. This shows us that people are actually still using Facebook. It might not be cool to talk about Facebook, but even among the millennials and the emoji coaches out there.
Hey, grandparents buy things too, so.
Yes, they do.
In defense of grandparents.
But my point is
people are people too.
The notion is how finite is the business, right? Is how finite is the world. And that's what Andrew Left, who I think is actually really sharp, that's his notion is there's only so much, so big they can get. There's only so many users that they can have. And right now we don't see those signs of slowdown. So I can't wait for these numbers.
There's also Instagram, which even folks inside Facebook have told me they were surprised at the engagement levels with Instagram and
Look
how
at
successful it is.
Yahoo buys Twitter for buys Tumblr for about $1 billion, about the same price as Facebook buying Instagram. Look what Instagram has done and Tumblr has not.
Corey Johnson, thanks for being here. Corey Johnson, Bloomberg News editor at large.
Well, since the S&P 500 hit 4 consecutive all-time highs 2 weeks ago, the benchmark has oscillated between gains and losses. Amanda has a chart showing you just how indecisive this stock market is. This is Bloomberg. We have breaking news on Alere. This is a medical diagnostic company with a market cap of $2.7 billion based in Massachusetts. According to Dow Jones, the company has gotten a subpoena from the DOJ's criminal fraud unit over Medicare and Medicaid billing. This is according to people familiar with the matter, as reported by Dow Jones. Again, Alere halted from trading at the moment of volatility trading pause. We did see the stock pretty much steady and then a big leg down on this report before the halt in trading. At last check, it was down about 28%.
More than 20%, even as its entire sector today is actually doing fairly well. So pretty bad news. Oh, we'll see. I think it tripped a circuit breaker, which is maybe why it was re-halted once it halted once it was reopened for trade. But so we'll watch Alere and see whether we get any firm news on that.
All right. We also wanted to take a look at the S&P 500 and how indecisive it has appeared over the last week and a half.
You know how you come across a chart and you fall in love with it? This is one of those for me.
Definitely.
This is a holding pattern. That's not it. That's Joe's chart. Joe can start. You want to start, Joe? I like that one too, by the way. But we've been talking about and watching these markets really range bound is how we've been calling it. And we know that that's been going on for a long time. But this, if we have it, will show you the oscillation. We are now in an 8-day oscillation. It's the longest since 1996, and there's just
Let me bring it up. I think they're having some problems bringing it up.
Technical difficulties, live television.
But I can bring it up in about 2 seconds. Here we go. But you can go back to my terminal, bring up my terminal, and Amanda can explain it.
There we go.
There it is.
Okay, so see the oscillation in the corner? So it is almost as though it was drawn with a ruler to be equally up and equally down. So sideways move. We saw that actually. It was interesting watching the market going into the FOMC today, waiting for some kind of reason to move in one direction or another. I don't think markets got it. So there's nothing to suggest that this won't continue, this sort of sideways action, looking for a cue.
I love that. I love the tension of that sideways action.
I know. What's going to happen?
What's going to cause a breakout? Right. September?
What is the signal?
Exactly. All right. Well, I'm looking ahead to the next central bank meeting. Not the Fed in September, but the Bank of Japan on Friday. And the chart that is really causing Japan such angst is Japan's CPI excluding fresh food and adjusted for sales tax increases. This is Japan's deflationary slump. It shows consumer prices going nowhere despite Abe's best efforts. Falling or stagnant prices, as we know, discourage companies from investing, and consumers feel no urgency to spend. So here's the challenge that the BOJ faces. That does it for Bloomberg Markets. What you missed and the market close is next. Take a look at the major averages as we head to the close. This is Bloomberg. We're moments away from the closing bell. I'm Scarlett Fu.
I'm Joe Weisenthal.
And I'm Amanda Lang.
U.S. stocks closing mixed this afternoon after the Federal Reserve left interest rates unchanged.
But the question is, what do you miss?
The Federal Reserve leaves interest rates unchanged but says near-term risks have diminished. We look ahead to whether the central bank will raise rates this year.
Plus, Facebook reports earnings in just moments. We look at how Instagram and video are driving the company's sales on mobile.
And it is day 3 of the Democratic National Convention in Philadelphia. President Obama will speak tonight about why Hillary Clinton should succeed him.
We begin with our market minutes, and as we mentioned, a mixed day for U.S. stocks here with, it feels like not a whole lot going on given the Fed did exactly what was expected, which was nothing. The Dow actually finishing unched. I have 0.00% as the move for the Dow Jones Industrial Average. As if you look at the S&P 500, slight decline there, and the NASDAQ also moving just ever so slightly up 0.6%.
I've always felt that the Yellen Fed has a remarkable knack for not making waves in the market, and today is just the perfect example with that 0% move in the Dow.
And that NASDAQ move, despite the fact that Apple, of course, had a giant leap today after its earnings after the bell last night. That's one stock to keep an eye on, plus 6% move. On the other side of the ledger, Deutsche Bank is falling, and there are concerns out there about whether this turnaround here is going to deliver. They're still weathering through cost cuts, layoffs, write-downs of businesses. The question is, can they actually generate enough income from their investment banking business to turn the ship around?
Let's take a quick look at the government bond market in the wake of that Fed meeting. We see yields lower across the board. They sort of whipsawed a little bit. In the immediate aftermath, they were actually green at one point, but you can see the grind lower continues.
The grind lower continues. As for the yen, it is selling off versus the dollar versus the euro because everyone's looking ahead to the big central bank meeting on Friday. The BOJ, we know that Shinzo Abe floated a trial balloon revealing a 28 trillion yen fiscal stimulus package. So the BOJ is up next when they meet Friday morning. We also want to mention euro pound. UK GDP reports show the economy grew faster than expected in the second quarter. Of course, that was before the Brexit vote really made an impact on the real economy. So economists are still looking for GDP to fall this quarter and next, basically pushing the UK into recession.
And let's talk a little bit about oil because that's really starting to tumble. It's at one point today it was below $42. It ended up at 42.01, but it's really been trailing off. We got more data that showed inventory is piling up. That seems to be the story. You know, for so long we've had this thing where the oil seemed to be driving the stock market. They moved in the same direction. But the story really over the last month, I would say, has been A, oil declining, and B, overall market not really caring about it.
Exactly, shrugging it off perhaps. Well, those are today's market minutes. Let's take a deep dive now into the Bloomberg. You can find all the following charts using the function at the bottom of the screen. Joe, we've got to start with WIRP.
Yeah, world interest rate probabilities. Let's see what the market is assigning to the odds of a Fed hike. And the simplest way to do that is to look just at what the market sees by the end of the year. You can see that by the December meeting, they're at 45.2% chance of a hike. Let's see what it was yesterday. If we change the date to yesterday, we can see that at that same meeting, it was slightly higher, 49.2. So ultimately, it took a little while for the market to interpret this, but a slightly dovish interpretation of the Fed with that decline in hike expectations.
Well, I'm taking a look at the yuan, the Chinese yuan, and copper. How do you say Dr. Copper in Chinese, right? I actually found out. It's Tong Yishen, for those who are keeping track at home. The base metal with the PhD in economics in recent years has been more linked to China. Copper prices in white and dollar yuan inverted in blue. So you can see that what's been happening here is am I looking at that correctly? Sorry, yeah, the renminbi in blue, yes, and it's inverted. So the falling line shows the yuan losing value versus the dollar. They move together, clearly, and copper is now seen more and more as a proxy for growth in China, the world's biggest user of industrial metals. So really, despite everything that's going on in the world, it's remarkable how consistently copper tracks China.
I'm taking a look at credit default swaps, at the spreads on them as a measure of risk. We've been talking a lot about the interest in the emerging markets, both equities and bonds. Last year, the spreads were widening on emerging markets. The risk was perceived as greater. Not so this year. This year, the spreads are climbing in the developed world and falling in the emerging markets. Now, of course, that is presumably a bit of a rotation as we've been talking about whether stimulus in some emerging markets may well actually help those economies. But that, to me, struck me as somewhat interesting post-Brexit.
That is a really fascinating chart showing how, we were talking so much about political risk in EM last year because there's Turkey, Brazil, South Africa, Malaysia. Those have kind of gone on the back burner this year, and all the political risk seems to be in Europe and the U.S. So really nice demonstration of that chart right there.
And it goes back to how political risks are driving those spreads wider for the developed world.
Yeah, it really says it all.
All right, I want to bring in Bloomberg's Corey Johnson. We are awaiting Facebook's earnings. And Corey, I know that engagement is the number, or is the metric, is the theme, we should say, for Facebook's results. Joe had a great chart earlier showing, oh, you know what? We do have Facebook numbers out. Let's pull it out. Second quarter revenue, $6.44 billion, beating analyst estimates of just over $6 billion, and certainly a vast improvement over what was expected, which was, $6 billion, what was reported last year, which was $4 billion. Earnings per share, 71 cents. If we're comparing like with like, that appears to be a miss. I'm not sure that that's the right comparable number here to the adjusted earnings per share that analysts were anticipating. Daily active users, 1.13 billion, slightly higher than what analysts were looking for. It was 1.12 billion was the average analyst estimate. And here we have the adjusted number for second quarter EPS. 97 cents was what was reported. Analysts were looking for 82 cents. So 97 cents, yes, better than even the most bullish analyst estimate out there. And in terms of monthly active users, 1.71 billion. The consensus estimate was 1.69 billion. And we should mention that monthly active users in the first quarter was 1.65 billion. So sequential gain as well there for Facebook. Corey, what are you looking at as you scroll through these headlines?
I'm actually going back to the original release to look at some of the numbers. I'm going to put some of these numbers in, but substantial growth year over year in top line numbers, substantial growth in profits here. I mean, for all of the technology companies that focus on getting the top line and don't worry about profits, we'll get there someday, the Amazon approach, we see a company here that's making a lot of money and plowing it back into the business and also throwing off a lot of free cash flow.
And making a lot of money, particularly in mobile ad. Mobile ad revenue was about 84% of total advertising revenue. Analysts were looking for 82.6%. A few years back, when Facebook was trying to really get its mobile game going, there was a lot of criticism that it didn't have a game plan, Corey, and it suddenly scaled up very quickly. A lot of people have questioned whether mobile ad revenue is fungible, whether you could just move it from one bucket to another.
Yeah.
Is that still a concern?
What we see some interesting things with these numbers, and we see some interesting things at Facebook. I know, talking to Facebook employees, that they think of themselves as a mobile-first company, that they encourage their people to think that most of their users will never, ever use a desktop computer. Think about that. Most of the users on Facebook will never use a computer. They will use it on their smartphones. They will, and most of the users are not in America. So the experience that we have of Facebook on our certainly not our work computers. But
no,
when we're
I was
home,
just looking at Facebook at work. I must be a dinosaur because I was on a PC. I'm clearly not a.
That's only because our boss is on vacation. I think that what we see from these numbers is that they're having great success in mobile, and that they're having great success driving advertisers to mobile, and advertisers are willing to pay for the Facebook experience in mobile, even though it's mobile. Of course, when we see Google of course sees a lot less revenue on mobile ads. These guys are really crushing it here.
I mean, the year-over-year percentage changes, really crushing it really is, there's no other description. You get into these large numbers and you still see a 63% jump in ad revenue year over year, total revenue up 59%.
Right.
I mean, you're seeing income from operations up 116%.
I mean, we had our jaws on the ground last year and they played $4 billion in second quarter revenues. Now they're doing $6.4 billion. So these are big numbers.
Guys, the stock is up 8%. This is a huge move. I just want to point this out to people.
It's already at a record high.
I mean, it was at a record high going into this earnings report. But you say crushing it, and that's just the only word that comes to my head right now. Maybe because we're all used to talking in cliches, and that's such a popular word. But seriously, that is a big move.
It's a big move. It's a big move for these guys too. I mean, these guys don't typically move that much. I mean, it moved 8% last 2 quarters ago, but tends to move about 2 or 3% after earnings, which is to say that the analysts didn't really change their numbers a lot going into this number. I've been looking at so many companies that just just barely beat, like Apple, for example, when the analyst numbers come down and then they beat that lowered estimate. The results of the analysts brought their numbers up at the end of last quarter and kind of kept them where they are.
Facebook's certainly in its growth phase. I just want to quote Mark Zuckerberg here, the founder and CEO of Facebook. He talks about how we're really pleased, particularly pleased with our progress in video as we move towards a world where video is at the heart of all our services. Of course, there's no breakdown. There's no details offered on video. There's also no details offered on Instagram. How do you measure how much Facebook can really monetize off video?
You know, the only numbers you can really get is looking at their revenue per ad and recognize that more of the ads are both mobile and video. So, but we don't really have hard numbers on that right here. They're very, and really it's true across the internet. The companies just don't like to reveal what their ad rates are, what their ads.
Right.
So we can calculate revenue per user, and that's I think a pretty useful way to do it. But we can calculate ad revenue for users, so strip out the 0.4% of their business that is data, but or payments and things like that.
But in a qualitative way, Facebook's big miss was not getting into mobile. Remember, Zuckerberg said we're not doing mobile. They had to pivot, and unlike any company that I've ever seen, they managed to go from nowhere to killing it in mobile in record time. So to me, this is a company that knows how to get into a new space and do it fast and put their energy behind it.
And remember that this is really the leadership from the CEO there saying, he was writing the shareholder letter on his mobile phone. He wanted people to think mobile first. As I mentioned, when I meet with Facebook people, they think about the fact that most of our users are not in the U.S. This is an international company. We see that in these numbers too. So they're growing in places where other companies are just starting to try to sort of get their feet wet.
I just wanted to mention, when we had you on before, we talked about the ratio of daily unique users to monthly. It's now at 66% based on 1.13 billion daily users, 1.71 billion monthly users. That is a new high. 66% is 65% as of last quarter. You look to this as an a key engagement measure, and it just keeps going the right way.
It does, and we'll get more exact numbers when they release the slideshow that goes with the earnings presentation. But what that shows you is that more people who are if you're on Facebook, the likelihood is you're on it every day. More than 2/3 of the users now on Facebook every single day that they're on.
Corey, within the press release, I'm looking at TLive Go, TLIV Go on the Bloomberg. It says that revenue from payments and other fees declined to $197 million from $215 million the year before. What does that encompass?
It's usually when the business launched, that was payments. A lot of that was Zynga, actually. It was people buying extra stuff within Zynga. So there are some services where people will pay while they use Facebook, and that's what these things are. And now Facebook, it is worth noting that in updates, they expect people to be doing some commerce on Facebook Messenger, and that's something to look for because they may be starting to derive fees from that.
Real quickly, what's something you want to get from the call?
I mean, I always love more details. I love more metrics. Obviously, they don't seem to be providing them, though. This company is fairly transparent, the metrics it does give out there. But I would love to know more about ad rates and how they differ from mobile than on desktop.
All right.
All right,
Corey
good
Johnson, thank you so much.
And make sure to tune in later this hour for Facebook COO Sheryl Sandberg. She's going to speak on the company's earnings, a beat here from Facebook on the bottom line and the top line. Coming up, Democratic heavyweights to address the DNC tonight. We're going to head live to Philadelphia next. This is Bloomberg.
Why are you so cheerful today? I had a fantastic week trading my Interactive Brokers account. Wait, are you an active trader too? I'm not, but I found a terrific financial advisor at Interactive Brokers Investors Marketplace. He manages my account, he built the perfect portfolio for me, put me into a couple of hedge funds that are doing great. How do you select the hedge funds? They're listed at the Interactive Brokers Marketplace. You should look them up.
Learn more at interactivebrokers.com/IB Marketplace.
We're watching Groupon shares climbing as much as 26% in after-hours trading. This is after the Coupon website boosted its full-year revenue outlook and EBITDA outlook. Its second quarter revenue also topped analyst estimates. Groupon paring some of its gains back a little bit there, still up 24% in after-hours trade. In the meantime, let's get to Mark Crumpton with First Word News this afternoon. Mark?
Scarlett, tonight President Obama will tell the nation why Hillary Clinton, his one-time fierce rival for the White House, should succeed him. His primetime address at the Democratic National Convention in Philadelphia will seek to convince skeptical voters, including some Democrats, that Mrs. Clinton is trustworthy, prepared, and ready to lead. It's a far cry from 8 years ago when their campaigns for the Democratic nominations were at times bitter. Also scheduled to speak tonight, Vice President Biden and Mrs. Clinton's running mate, Virginia Senator Tim Kaine. A warning from FBI Director James Comey. Hundreds of terrorists will seek to infiltrate Western Europe and the United States to carry out attacks as Islamic State is defeated in Syria. Speaking today here in New York, Director Comey said he expects a, quote, terrorist diaspora out of Syria, adding that the future has already emerged in places like Brussels and Paris. He also said those attacks will be carried out on a wider scale. In France, one of the Islamic State supporters who stormed a church and killed a priest reportedly was on a terror watch list. The Associated Press says he was forced to wear an electronic tag that let police track his movements. Police commandos shot and killed the two attackers. Prosecutors have dropped the remaining charges against Baltimore police officers in the death of Freddie Gray, a black man who was critically injured in the back of a police van in April of 2015. The decision comes after a judge had already acquitted 3 of the 6 officers charged in the case, including the van driver and another officer who was the highest ranking of the group. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Mark Crumpton. This is Bloomberg. Scarlett, back to you.
What'd you miss? Day 3 of the Democratic National Convention may be the biggest yet. President Obama to headline tonight's lineup of heavy hitters, which also includes Vice President Joe Biden, as well as Clinton's Vice President pick, Senator Tim Kaine of Virginia. Now, with the latest headline-grabbing comments from Donald Trump, tonight's speakers are sure to make him a target of the conversation. Joining us now from Philadelphia is Bloomberg's Margaret Tlaib. Margaret, the president, obviously the biggest speaker, all-star speaker tonight. His wife, the First Lady, gave a very stirring, well-received, highly praised speech earlier this week. Do we have any sense of what the president will focus on when he speaks tonight?
Yeah, absolutely. I mean, look, he's going to make the case for why he believes that Hillary Clinton is the best person to carry on his legacy. But this is probably going to be a speech that's more focused on her than it is on him. Implicit in his argument will be that at least the people in the room and a majority of Americans, according to the most recent polling, think that he's done a good job. And so he'll make the case that she is the right person to continue his legacy. But this really does sort of bring his story full circle. It was 8 years ago that the Clintons put aside their egos and disappointment and got behind him to help make him president. And tonight, President Obama, joining his wife's comments from the other night, will begin to actively make the case for nominee Hillary Clinton to be the next president.
I don't know, Margaret, whether there was a plan to talk about Donald Trump before today. It seems inevitable that Trump's comments about Russia hacking emails will be on the agenda here. Is that your expectation, that there'll be more of an attack tone than we might have thought?
Yeah, I mean, when you look at kind of the speakers list for the night, not just President Obama, but the Vice President Joe Biden, Leon Panetta is going to be speaking. Some of the other speakers have a military national security background. This was always going to be kind of a foreign policy, national security, 3 a.m. phone call kind of a night. Trump's comments make it imperative for them to address it, and they've already begun doing so today. Robbie Mook and John Podesta, 2 of the top officials on the Clinton campaign, talking about how this is beyond the realm of politics. It's a national security issue already. The question, particularly for President Obama, is how will he balance his original plan, which is to make an affirmative case for Hillary Clinton, against his desire to kind of swat away Donald Trump. Trump wants to insert himself into the conversation. At least in the short term, he thinks that's the right goal, to take them off course course, make it about himself. So the Clinton and the Obama folks, the Democrats, need to balance how much they want to address him versus how much they just want to ignore him tonight. And we'll be watching to see how they do that.
For sure. I mean, obviously, one option is to wait for closer to a general election and trot Trump's remarks out later on. What do you think is on kind of the talking points list that folks like Obama want to hit tonight?
Well, they do want to hit on the notion of Trump. They want to hammer away as soon as possible before the summer is over on the issue that he isn't fit to be commander-in-chief. But in terms of Hillary Clinton, they want to make the case that she has the right temperament, that she has the right experience, and that they like her. It is the likability factor has been one of the biggest challenges for her. It's hard to sort of talk in rhetoric about why someone else should like her, but they can talk about their own experiences getting to know her and how that changed their minds. They also just hope that their own popularity will carry over. President Obama has very high favorable ratings among Democrats and some of those swing voters that Hillary Clinton is hoping to persuade. So this may be a personal speech, probably not quite as personal as Bill Clinton's the night before, but he will talk about how their relationship changed over the last 8 years and how he knows her better now and why he believes she's the right person to carry on his legacy.
And speaking of likability, Tim Kaine, the senator from Virginia, has a high likability factor. That's partly why Hillary Clinton picked him as her running mate. Others say that she really picked him because of his contribution, his ability to help govern. What can Tim Kaine say to help move the undecided voter into the pro-Hillary camp?
It's interesting. Tonight really will be his introduction to an awful lot of voters. And there's some thought by the Clinton campaign that he can help specifically with Catholic voters, with Native people for whom Spanish is their first language, and with gun control advocates. But it is, again, a lot of about it is just personality and personality cues. And it's interesting. We saw him speak to the Virginia delegation this morning, and he teared up. He was very emotional, talking about the path ahead and the recent death of one of his own top advisors. And many of us in the room thought he reminded us of Joe Biden just a little bit, wearing his emotions on his sleeve. Yeah, so.
All right, Bloomberg's Margaret Talev from Philadelphia. Thank you very much.
Coming up next, where can global investors find higher yields? We'll tell you where the opportunities are. This is Bloomberg.
What you missed? Global aggregate bond markets have outperformed global equity markets so far this year, and that may leave many investors wondering if bonds still offer any value. Joining me now is David Schall, portfolio manager for New River Investments. This extraordinary bond rally in anything yielding, any yield products, it's really the story of the year. Are there still opportunities out there?
Yeah, that's a great question. I think that's something on everybody's mind. You talk to kind of anybody, whether it's individual, institution, a question that always comes up is, where can I find yield? And to be honest, it's not an easy question, especially, going back to the beginning of the year, we've had a very large rally in credit and in duration in 2016. So compared to that time, things are a lot richer.
Explain that. So you say it's not really yield that's driving this rally or the search for yield, but duration. What's going on?
Correct. So, just the level of interest rates in general, specifically the intermediate part of the curve and the long part of the curve, interest rates have fallen so much. So if you look at the total returns on bond portfolios or bond funds, really the ones that have outperformed have been driven by duration. So if you've held 1 to 3 year bonds instead of 10-year bonds, you've pretty much lagged the market. So going forward, you can never say never. Duration can still make an impact, but with this flattening curve, with rates falling, the opportunities for return in fixed income are a lot tougher right now. So I think people have got to go kind of off the beaten path a little, which is a tricky thing.
So what are some of these areas that maybe people aren't thinking about?
That's correct. So, people often benchmark to the Barclays Agg, and in the Barclays Agg is very common things such as treasuries, investment-grade corporate bonds, but kind of moving outside of that, if you think about something like legacy, non-agency mortgages. So these were mortgages originated before the crisis that are still around, that haven't defaulted. You can buy them under par, and really you've got the tailwind, hopefully, of a consumer that's improving their balance sheet and a credit quality that has tailwinds behind it and not a potential credit concerns ahead of it.
Another area that there's growing interest in is REITs, especially because people talk about, well, they've done extraordinarily well. Take a look at the Vanguard REIT Index, for example, or REIT ETF. There's also this re-indexing of them, that they're getting their own category. Are there opportunities there?
Well, I think that there were. I mean, it's been such a gigantic rally.
You see the 15% year rally over the last year.
Yeah, and I think the way people are looking at this, it's partly reasonable and partly not, as they're saying, they've got to pay out income. These are reasonable yields. I'm going to kind of look at it as a fixed income type instrument, even though the underlying is not fixed income. So whether it's, a mall REIT or a REIT of office properties, or, there's other types of REITs out there which, for instance, buy mortgages, mortgage REITs, which essentially buy mortgages, repo the bonds, buy more, and kind of leverage up to earn a spread.
Real quickly, I want to get your take on banks, because some of them are high dividend payers. On the other hand, net interest margins, it looks like they keep compressing. On any part of the capital structure with banks, do you see opportunities?
Yeah, that's a good question. No, you're right. I'm not very optimistic on bank equity. However, I think that the debt of financials has really lagged. So I think that there's a lot of value in investment-grade financials and some that have crossed over to high yield. And then one other area is in the preferred space. So as long as you're kind of comfortable that long-term rates are going to stay where they're at, you can earn pretty good spreads buying financial preferreds right now.
All right, David Schall, New River Investments, portfolio manager. Thank you very much.
Coming up, we already heard from the FOMC, but what can we expect from the Bank of Japan on Friday? We've got a preview next. This is Bloomberg.
I'm Mark Crumpton. Let's get to First Word News. Donald Trump says he has, quote, never met Russian President Vladimir Putin, has, again quoting, nothing to do with Russia, and was not convinced that Russia was responsible for the Democratic National Committee hack. In an unusual appeal from a major party's presidential nominee, Mr. Trump called on Russia to hack Hillary Clinton's emails.
Russia, if you're listening, I hope you're able to find the 30,000 emails that are missing. I think you will probably be rewarded mightily by our press.
Mrs. Clinton's advisor, Jake Sullivan, said Mr. Trump's remarks were unprecedented and had, quote, gone from being a matter of curiosity and a matter of politics to being a matter of national security, end quote. The daughter of President Ronald Reagan is criticizing a judge's decision to grant freedom to John Hinckley Jr., the man who shot the president and 3 others in Washington 35 years ago. On her website, Patty Davis says she will, quote, forever be haunted by the day her father nearly died, and that her, quote, heart is sickened by the decision. The jury found Hinckley not guilty by reason of insanity. Once he's released from a government psychiatric hospital, he'll live with his mother in Williamsburg, Virginia. British lawmakers are warning the Brexit vote could lead to a spike in immigration. That's from a report by a House of Commons panel. It says the previous attempts to tighten immigration rules have led to a surge of immigrants. The UK's vote to leave the European Union has raised the prospect of limits on EU nationals wanting to move there. Japan's Prime Minister Shinzo Abe plans a $265 billion stimulus program to prop up the economy. It's unclear how much of the package will be new spending. Abe's ruling coalition won a big victory in upper house elections earlier this month. After that, Abe ordered his government to come up with the stimulus plan. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Mark Crumpton. This is Bloomberg. Scarlett, back to you.
Thanks, Mark. Let's get a recap of today's market action. A bit of a yawner here in equities, with stocks ending mixed, little changed. Treasuries rose, the dollar fell. The Fed, basically a yawner of an FOMC meeting as well, holding to their intention to tighten rates gradually. What we're paying attention to, though, is the after-hours trade of Facebook. Facebook beating on the top line, beating on the bottom line. Monthly active users, daily active users, all topping analyst estimates. The stock up better than 6.5%. And the COO, Sheryl Sandberg, saying that the company is not focused on monetizing WhatsApp or Messenger yet. They're not interested in long-term content deals, but they are in early testing for monetizing Messenger chats. And we're going to get more details from Sheryl Sandberg, the COO of Facebook, a little bit later on.
Keeping an eye on Groupon stock jumping after hours off a smaller base, 24% increase, because not only are they beating a smaller than expected loss per share in the quarter, revenue beating $756 million, not $711. The big news for this one, though, is their full year EBITDA projection. They're saying $140 to $165 million on the year, and it had been $85 to $135. So a sizable increase in what they're looking for on EBITDA, and we're seeing a strong market reaction after hours.
A sizable gain, you could say. What'd you miss? We're awaiting some key central bank meetings later this week and next, specifically the Bank of Japan on Friday and, of course, the Bank of England next Thursday. That central bank expected to cut its interest rates to a record low to cope with the fallout from Brexit. Here with some insight now is Dr. Neil Sauce. He's the Vice Chairman of Global Fixed Income and Economics Research for Credit Suisse. And Neil, we'll get to the BOJ and the BOE in a minute, but I wanted to just get your first thoughts on the Fed. They did nothing as expected, but what did they communicate in adding the line that the near-term risks to the outlook have diminished?
Yeah, that's one of the very convenient things, by the way you print out the statements. It kind of highlights what the change has been. And I suppose what that's a reference to is that Brexit, which was a looming event the last time they met, came and, at least from the market's perspective, came and went. So that risk hasn't materialized yet. I suspect there may be more to that story down the road, but so far so good.
All right, let's turn to the BOJ because Scarlett's been saying this is the real story, and the markets really of the week, and the markets really seem to agree with her. If you look inside the Bloomberg, I have a chart of 1 week implied dollar-yen volatility. It's at its highest level since 2008. One of my colleagues joked that if the BOJ does anything short of curing cancer on Friday, people might be disappointed. What is it about this meeting that's really caused people to focus on it so much?
Well, I think part of it is that the government, Abe's government, has sent signals through its announcements about fiscal efforts that suggest that we are at the threshold, at least, of seeing a more coordinated fiscal and monetary push, not just in Japan, but more broadly around the world. And a lot of economists have been of the view, and a lot of central bankers have been of the view, that monetary policy's done most, if not all, of what it can, and we need the fiscal effort to go with it.
And on that front, of course, the Bank of Japan is getting more creative because its options are more limited. How we hear all the time experts saying we're in uncharted territory, we know there are market distortions, we don't know what the outcome will be. Japan has a long history with failed experiments on monetary policy. How worried are you when they start buying ETFs and other instruments?
Well, Japan is in a somewhat different circumstance, let's say, from the U.S. Japan is a high savings country. So to the degree that there are distortions, they manifest themselves perhaps in different ways from the ways that we would see them. And frankly, I'm not sure it's as distorted as it might seem at first blush. When they went to negative rates in a number of central banks, I must say my first thought was, does bond math actually still work with negative rates? And it turns out it does, which is remarkable in its own way. But, you know, for the Bank of Japan, supposing they announce that they've got an inflation target of 3 or 4%, that's going to encourage people. Well, they haven't been able to hit 2. So it's suggestive that that's not particularly material. They've already bought a very significant fraction of all the government debt. So this notion of helicopter money doesn't really mean much, because is there really an expectation that the BOJ will someday insist that the Treasury pay it back? This is helicopter money in everything but the name, and I frankly think the name's not very helpful. If they go into a deeper effort to buy private issued securities, then you get into the issue of what part of the government is supposed to influence the allocation of capital, which we traditionally don't think of as central bank, but rather as a legislative function, executive branch function. And I think that's got to be the next big step for all of them.
You're muddying the waters a little bit there. You could argue, and some would say, that Shinzo Abe has a greater mandate to do more now after the July 10th elections. Is there a limit to what Abe or even Mario Draghi at the ECB can do in their vow to do whatever it takes to achieve their targets? I mean, is there a limit to their no limits?
Well, I think in Japan's case, not so much on a cyclical horizon, can they make the economy function better for a couple of years, but how do they fix the long-term problem? The long-term problem in Japan, one way to think about it at least, is that fertility is so low that the population of Japan is smaller this year than it was last, and has every reason to expect it will be smaller next year than this, and so on, ad infinitum. And a society like that will, through the laws of demographics, age. And what kind of dynamism do you get from that? So to me, at least, the real solution, if you will, for Japan is to recreate an environment in which the young women and the young men decide that having the next generation of young women and young men is a desirable activity.
I imagine that's just a little bit outside the purview of the Bank of Japan, however.
Well, it is. And we've tried from time, I shouldn't say we, but, you know, societies have tried pro-natal policies. You know, you can give tax breaks to people who have larger families. You can give, you know, all sorts of incentives. Sometimes they work, sometimes they don't. It's all rather a mystery. But raising the wages of younger workers, I think, is in a sense the most direct and effective way to do this. You encourage family formation when people say, well, wait a minute, I'm making good money, I'm making a good living, let's start a family, let's get together here.
I want to go back to something you said earlier. You said, you know, helicopter money is kind of a distracting term. No one really expects the BOJ to ever force the government to pay it back. Bloomberg News' Chris Anstey wrote a column this week saying one thing the BOJ could do is explicate that they're never going to unwind the balance sheet. This is now the level. Would that get them anywhere?
It's an announcement that if I read it, I would have said, why didn't you tell me something I didn't earlier know and believe? I frankly think the same thing for the Federal Reserve. We've never, in modern times, been able to run a a large mortgage market in the U.S. without the government in some form owning a lot of the mortgages. That was Fannie and Freddie and their retained portfolios before. It's the Federal Reserve now. They keep saying we're going to eventually think about unwinding this, but I'm not so sure, because that prepayment option is the sort of thing that gave rise to the need for the government's involvement in the first place. And more broadly, do we really think that any of these central banks can, quote unquote, exit from these policies until the economies are functioning way better than they have been doing, and way better than is reasonable to expect over the next couple of a visible horizon anyway?
All right, Neil Salz, Vice Chairman of Global Fixed Income and Economics at Credit Suisse. Fascinating conversation. Thank you very much for joining us.
Thank you.
And coming up, we'll hear from Facebook CEO Sheryl Sandberg on that company's earnings. This is Bloomberg.
I'm Scarlet Food. It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. Shares of Groupon soaring in after-hours trade. The company posted a second quarter loss, but it is boosting its full-year revenue and EBITDA outlook. Groupon sees 2016 sales of $3 billion to $3.1 billion. That is better than the consensus estimate and up from an earlier range of as much as $3.05 billion. Action camera maker GoPro reporting second quarter earnings that beat analyst estimates. The company got a boost from renewed demand for its tiny cube-shaped cameras ahead of the introduction of a new model later this year. GoPro's adjusted loss was 52 cents a share. That was 7 cents better than projections. GoPro is maintaining its full-year revenue forecast and sees a profit in the fourth quarter. And shares of Facebook on the rise in extended trading. Second quarter revenue topping analyst estimates, lifted by sales of video and Instagram ads. Sales climbed 59% to more than $6.4 billion. Adjusted earnings per share was 97 cents, 15 cents better than the consensus estimate. Facebook now has more than 1.7 billion users. That is up from 1.65 billion in the previous quarter. And that is the Bloomberg Business Flash.
And sticking with Facebook, Bloomberg's Emily Chang has just gotten off the phone with Chief Operating Officer Sheryl Sandberg. She joins us now from San Francisco with the details.
So, hi, Amanda. Obviously, a strong quarter from Facebook across the board. Cheryl told me that it was success across all of their verticals, all of their regions that really drove this. We started by talking about the hot button topic of Facebook Live. Given the early momentum that we're seeing there, what are the monetization opportunities? And she said, look, Facebook Live, the content lives in the news feed. So this is just another opportunity to increase engagement overall across Facebook, and ads live in the news feed, and therefore Facebook Live can drive overall advertising revenue. Take a listen to what she had to say.
The explosion of video on the platform is great for consumers, and it's also great for our business. If you think about all the new formats, and a lot of them are video like live, but also recorded video, but also 360 pictures. All of these formats are really engaging, and we think they're contributing to our time spent metrics.
So there will be no ads tied to Facebook Live in particular, but Facebook Live is driving what they believe is to be time spent. I did ask about Instagram. They're not breaking out revenue for Instagram yet, though. One UBS analyst estimates that Instagram contributed about $550 million in revenue to this particular quarter. She said they continue to be really excited about the possibility on Instagram that it is driving meaningful revenue, and that they believe between Facebook and Instagram, they have the two most important mobile ad platforms out there. She did hint at monetization opportunities for WhatsApp and Messenger, and talked about the amount of messages they're seeing being shared between businesses and consumers organically. They're really focused right now on building out that consumer experience because they know that the opportunity there is so huge. Mark Mahaney at RBC Capital Markets said he thinks that Messenger and WhatsApp could contribute $10 billion to Facebook revenue by 2020. But take a listen to what Cheryl had to say about the early stages of testing revenue opportunities around messaging.
We're doing some very early testing to see how we can monetize and drive those engagements between business and consumers. But right now, it's the organic activity that we're looking for.
Now, we did ask for more color on, what kind of live content they're looking for. Of course, we know that Facebook is now paying media companies, paying public figures to post live content on Facebook. We also know that down the road, there is a plan to allow some of these content creators, give them a part of the cut of the revenue. But in particular, are they going to be looking at content deals like what we've seen with Twitter? Twitter's made deals to stream NFL games, to stream the Republican and Democratic national conventions. Take a listen to what she had to say.
Right now we're in the really early stages of working with publishers and content producers to create content for our platform. We're much more interested in short form content because it just fits with the way people are using Facebook right now, and so we're not pursuing any of those longer deals.
So we're not going to be seeing those Twitter-like deals with Facebook anytime soon. We're going to be covering this a lot more in-depth coming up on Bloomberg West. I'll send it back to you guys.
Emily, quick question. In the last several months, I think there's been more and more talk about Facebook competitors, whether it's Snapchat or all the time spent on Pokemon Go and that taking attention away from the company. Are they anxious at all about these rising competitors for people's phone time and attention?
Whenever we've asked Facebook executives about competition, they really don't seem that worried about it. And the outside analysts that we've spoken to have said that whatever engagement Snapchat is seeing is not contributing meaningfully or taking meaningfully away from what you're seeing on Facebook. I mean, if you look across all of these metrics, whether it's revenue or profit or monthly or daily active users or mobile monthly users or mobile daily users, Facebook continues to, knock everyone else out of the park quarter after quarter. And I believe in every single quarter since the quarter that they went public, May 2012, they have beaten estimates. So they continue to show great promise. They've got a lot of potential revenue opportunities between the Messenger apps, between Instagram and Oculus, that Facebook seems to be in a really good spot right now.
All right, Bloomberg West anchor Emily Chang, fantastic stuff. Thank you very much.
Coming up, the yen falling by the most in almost 2 weeks after Japanese Prime Minister Shinzo Abe surprised investors with a fiscal stimulus package exceeding $265 billion. We'll discuss next. This is Bloomberg. I'm Scarlett Fu. What'd you miss? A busy day for yen traders. Japanese Prime Minister Shinzo Abe made a splash in markets today with an announcement that planned fiscal stimulus will be more than $265 billion. The yen declining in value, and of course, Japanese stocks gained on the news, but details were limited. Beyond that first number that Shinzo Abe gave, the hows, the whys, and exactly what part is new spending, that was all left up in the air.
And in fact, even the way it was presented to the market was strange. This wasn't sort of an official announcement. It was a speech. It was kind of off the cuff. A couple of days ago, there was a leak about what the stimulus would be, and that was disappointing. So this has been kind of an interesting road to clarity on what Japan plans to do.
Absolutely. So here to bring us some clarity is Bloomberg's Betty Liu.
I hope.
Didn't it feel like a bunch of trial balloons were being released here as Shinzo Abe tried to figure out what kind of number, what kind of detail the markets wanted to hear?
Exactly, and you're absolutely right. It was a little bit odd the way he revealed it. You know, not in Tokyo, somewhere 900 miles away, and it seemed kind of off the cuff. He didn't even announce the actual number until well into his speech, and so it was all kind of discombobulating for the markets, which you saw reflected in how the yen declined, then it shot back up, and then it declined again. But it's very, very clear why he did it, and perhaps it was done quicker than he would have liked. Because the BOJ is going to begin their two-day meeting tonight.
Yep.
So by giving out at least the headline number, which is 28 trillion yen, almost near the top of where people's forecasts were for this stimulus package, it just puts it squarely in the BOJ's hands on what they're going to do next. You know, he's got his government package now out of the way. You know the number. We don't know all the details yet. So now it's up to Kuroda and team.
If we go inside the Bloomberg, I've got a 1-month chart of dollar yen, and what's really striking is that the yen dollar yen really started to go up. So it means the yen is weakening right after that election in which Abe's party did very well in the upper house, giving the government sort of a reinvigorated opportunity to pursue stimulus. We talk about the BOJ a lot, but how important ultimately, I mean, is the fiscal side? Is the the third era, whatever it is, that the government does their part?
Absolutely. And it's not even clear, Joe, that this fiscal stimulus really addresses the third era, which is all about labor reform. Right? I mean,
I may have confused my era.
No. There could be a fourth and a fifth one at some point.
They might need it.
Exactly. I mean, but you make a great point here, though, which is, you know, increasingly this is more and more important. You know, the markets didn't really react that well when they went into negative rates territory. So how much more, you know, really can the market stomach out of the BOJ? However, the big question with this fiscal stimulus package is how much net new money is this really? You know, did he just sort of pull one of these, you know, let me repackage what we've already announced and make it sound really big, and hopefully like the markets, you know, sort of throw a blind eye to all of this, right? So I think that is yet to be seen. There aren't any details yet. There's going to be more details to come in the next few days. But really, how much more new money is there really being pumped into the economy? That is a big question.
And do you expect to see a market reaction once we do get details, both from the, both on the fiscal and on the monetary side?
I think so. I mean, I think you've seen the market reaction so far on the fiscal side. We'll see again, like how much net new money there really is.
Yeah.
But I think the markets are bracing for a surprise out of the BOJ. So it's really unclear how they're going to react.
Yeah, and you really go back to that dollar-yen chart that you were just showing us. It used to be a proxy for reaction to the Fed. It's more a proxy for what Japanese fiscal stimulus might look like.
Right, and just really quickly, do we have time? I want to just pull up that
We
chart.
got to run, apparently. And I don't have it on my screen anymore.
Okay, never mind.
Betty Liu, thanks for joining us. You can catch Betty and that chart, perhaps, with Yvonne Mann at 7 p.m. New York time, 7 a.m. Hong Kong, and on Daybreak Asia, which is on the Bloomberg.
Coming up, what you need to know to gear up for tomorrow's trading day. That's next. This is Bloomberg. miss this. German unemployment coming out tomorrow at 3:55 a.m. Eastern Time. Could move the euro.
And I'll be looking at, as I do every 8:30 a.m. on Thursday, U.S. initial jobless claim.
After the ballots, Amazon will have that for you tomorrow.
That does it for What You Missed. Thanks, everyone, for watching.
We'll see you back here tomorrow.
Have a great evening. This is Bloomberg.
Donald Trump asked Russia to hack into Hillary Clinton's email.
Ladies and gentlemen, I can assure you that our grand-scale plans will be delivered.
Happy DemsCon Day 3, comrades. Here's what we're Putin in our show tonight. The Democratic Convention is bringing out the big guns here in Philadelphia, even bigger than the past two nights. VP Joe Biden, our boss Mike Bloomberg, Clinton running mate Tim Kaine, and President Barack Obama all taking the stage later this evening in that order. But first, let's talk about the Democratic National Committee's still unfolding